Excellent. Well, I'd like to call the investment committee meeting to order, and I'll pass it back to you, Ellen, for the roll call.
Certainly. Good morning, everyone. Trustee Bartholomew.
Yes.
I believe Trustee Ames is not available to join us. So Trustee McMahon,
Yes.
Trustee Martin,
Yes.
and Trustee Riley.
Yes.
We're all set.
Excellent. So without further ado, welcome to the meeting, and I hope everybody's been enjoying their summer. And I'd like to draw our attention to tab 1, approval of a non-voting, non-trustee member. This morning, if you look around, I don't want to say look around the table, look around the computer screen, you'll notice that we have an additional person, Timothy Griffin, and we're asking you this morning to add another non-voting, non-trustee member. Basically, we've just went through this not too long ago with appointing Jim Bradley and Matt Scaves. So basically what it is that the investment committee can add non-voting, non-trustee members, and we benefit from the expertise of these professionals because they serve in the occupation, and they basically have been very helpful to giving us additional perspectives and adding value to the committee. So I'd like to give you a little background on Timothy Griffin. Mr. Griffin is a graduate of the University of Southern Maine and is current treasurer of the USM Foundation. The portfolio manager with HM Payson of Portland. He manages over $400 million in assets for 120 clients, including individuals, trusts, endowments, and institutions. He also serves on the board of the Dempsey Centers of Quality Cancer Care and the State of Maine's Advisory Committee on Educational Savings, United Way, Brick and Beam Society, and the United Society of Shaker Sabbath Day Lake Incorporated. So I'll just turn it to the committee. If anybody has anything to add, I wanted to give you a background on Timothy and a little background on the non-voting, non-trustee members. Ask if anybody on the committee has anything to add before I read the text of the proposed resolution.
Sounds good.
So hearing none, I'll read the text of the proposed resolution that the Board of Trustees, acting through the Investment Committee, approves the appointment of Timothy Griffin to a 3-year term as a non-voting, non-trustee member of the Investment Committee effective August 25, 2022. Do I have a motion?
So moved.
Second.
Moved by Trustee McMahon, second by Trustee Riley. And Ellen, I think I pass it to you, correct?
Yes, thank you.
All right, thank you.
Trustee Bartholomew,
Yes.
Trustee McMahon,
Yes.
Trustee Martin,
Yes.
Trustee Riley.
Yes.
The motion is carried. Welcome, Timothy.
Thank you very much. It's great to be part of the group.
They probably lied to you about the pay, but I didn't want to say anything until after.
No promises were made.
Just keep on looking at your that bank statement for that deposit, right? So welcome Tim, and
Thank you.
definitely value the input and expertise from our non-voting, non-trustee members. It definitely helps us with decisions we have to make. We value your perspective. So thanks for agreeing to serve, Tim, and thank you to Matt and Jim for your continued service as well. So moving on to tab 2, the investment committee's work plan. I'm sure that you guys have had a opportunity to review the work plan. So basically this is basically our parameters of when we discuss what and at what meetings. Does anybody have any questions or concerns or additions, edits for the FY 2023 investment committee work plan? It sounds like everybody's in agreement with the work plan. So that's a good thing. So the next item on the agenda will, are is Barry on the phone yet?
I don't see him.
Don't see him. We're not terribly ahead of schedule, but anybody have a joke?
I just sent an email, Kelly. I'm curious, Heather, were you sure to include them on the active link?
Yep.
Okay, I haven't heard yet back from them. So a joke would be good.
I spent all last week telling my nieces and nephews the following one. They're not making 12-inch rulers any longer. Let that sink in for a little while.
Am I supposed to say why?
No, you're just supposed to think about why they wouldn't be making 12-inch rulers any longer.
Oh.
Oh,
I like the emphasis.
oh, I haven't had enough coffee.
I'm sorry, I have to use that one today.
The teenagers love that one, I'm telling you.
Yeah, that's a good morning joke too. Because you get the blank stares, right?
Right.
That is a professional dad joke right there. for sure.
Absolutely.
I love dad jokes, they're hilarious.
So Tracy, sorry about that. I thought we were on at 9:20.
Well,
Mike?
maybe we went through the agenda items quickly, so I think you're up now. No problem.
Oh, okay. No, so really sorry sorry about that. We were actually just sitting here waiting to dial in.
Yeah.
So Mike, you were on for 9:20. We've been moving pretty quickly here this morning, and while we were waiting for you, we were hearing dad jokes.
Oh,
Kind of good that you joined as quickly 10 minutes in advance, right? Jim, go ahead. You got to share it with the group.
Oh,
With
oh,
Mike
for
and
the
Barry.
for the benefit of Mike and Barry,
Yeah.
I just want they're not making 12-inch rulers any longer.
That's one of those, what we hear so much about now, these dad jokes, right? A joke that only a dad would find funny.
Yeah.
All right, without any further ado, I'll transfer the floor to you guys, Mike, Barry. Without further ado, if you could share with us the defined contribution plan quarterly review.
Mike, do you want me to share? Or do you want to share?
Why don't I share, and you want to just tell me what page to go to, Barry, and then I'll take over when it's my turn.
I'm gonna.
So
Good morning, everybody. I am going to cover the topical spotlights and the market. Then I'm going to turn it over to Mike to talk about a couple funds that are certainly challenged during this pretty volatile period of time. So, Mike, if you turn to page 12 of the UMaine deck. As you all know, what we want to make sure of is you are no longer the 90 days out of things that are taking place within the market. And so we're pretty light on the topicals this particular period, but we thought it'd be a good opportunity to share with you a couple things that we're thinking about in terms of the overall plan. And the first topic is QDIA, so the default. Somebody joins the University of Maine system and they don't make an election, automatically they go into the Vanguard target date funds. And, they're obviously well allocated portfolios that decumulates over time in the sense that less equities as you get closer to retirement. And if you look at our client base, most of our clients have target date funds as the QDIA, the default investment vehicle. You have about 230 some million or 13.5% of the assets in the Vanguard target date funds, and that continues to incrementally go up over periods of time. If you kind of think about the evolution of target date funds, if you look at kind of the middle chart, what we've been seeing over the course of the last decade is as people live longer, as markets have really done well, absent of 2022 thus far, we started to see a lot more rigor associated with the glide path itself. Consequently, a lot of these investment managers increase the equity exposure. You can see, the equity exposure from 2011 to 2021 have increased pretty dramatically over that period of time. That's just an observation. We don't necessarily have a comment on that. But again, if people are living longer in retirement, you would expect that you would need to have a more equity exposure even in retirement. So that's probably kind of stands to reason. But then we're also thinking about like what's next. Like we spent all this time on the accumulation phase for the faculty and staff at University of Maine system, and like what's next? Like we're starting to see some products out there. We do anticipate having some more meaningful conversations in 2023 about, well, what's when we get to that point, or somebody gets to that point of retirement, what do they do? And that's kind of the decumulation phase. We've seen some offer managed accounts, TIA offers managed accounts. We've seen some start to think about a particular target date fund or target date fund complex that is geared towards decumulation, maybe withdrawal rate types of structure. We've seen independent advice where participants can call in and create a custom portfolio for the decumulation phase. So we do see this is an area that we would anticipate having more dialogue with you all in the future as more products come out into the marketplace. The next page is really just, and you all are doing these things. So this is really just, we took a snapshot of our client base. So this includes 401k plans, 403b plans, 401a plans, and the kind of evolution on plan automation. As we all know, inertia is live and well in your plan and many other plans. And so things like automatic enrollment, auto escalation, are key attributes of increasing readiness of plan participants. And then we look at kind of the right-hand side, employer contributions. We've seen some at least take a step back and say, hey, should we have, instead of just non-match, should we have match and non-match? So that's obviously for you all, it's really more dictated at the state level. But it is something that we do think about, like how do you increase the likelihood of success for plan participants in a myriad of ways. And at the bottom are simply some, we look over kind of a period of time, the last 5 years, we've seen some slight increases in those percentages offering loans, offering hardship withdrawals. We have seen actually a slight decrease in the percentage offering annuities. We think that will probably, with the Secure Act 2.0, probably reverse course a little bit and have more integration in annuities within the platform. And certainly you have those in the TIA side. Installments, partial distributions, again, making sure participants have some ability to gain access to these funds in and including retirement. If we flip to the market, I had an advisor last week say, Barry, just flip this chart upside down and it's all good. Clearly it's not. If we look at through the end of June, clearly we've had a lot of negative volatility in the marketplace. You think about the pandemic, you think about the war in Ukraine, you think about the supply chain issues that we've had, and it's really just exacerbated a kind of a natural inflationary environment as we're coming out of the pandemic period. And so you don't have these numbers here. You can see the numbers on the page, but as of yesterday, just to give you an idea, we've had a little bit of a pivot point, albeit minor, but like the S&P 500 as of yesterday is down about 12.25%. So instead of 20% that we've actually had a resurgence of about 8%, a little less on other areas like the developed international is now down year to date 17.5 versus 19.3. Emerging markets is down additional. So they're down 18.25 versus 17.5 on the year to date basis through June 30th. U.S. small cap stocks down about 13.10. So they've had about a 10% rise. And then US bonds, typically US bonds has been really that they safe haven because of the Fed and the action the Fed has had to take to combat inflation and significant rises of interest rates over short periods of time. It's not really been a safe haven. There's not been a lot of places to hide in this particular market. The US bonds is down on a year-to-date basis, 10.4%. So they're kind of where they are as of the end of June. The one area, commodities, obviously, with oil and energy prices the way they are, energy has been really the top performing sector of the market. I think they were up as of yesterday about 53%. So that's clearly been kind of the one positive asset class or sub asset class that we've seen in this current market. If we go, Mike, to page 18. No, Mike, it's the other way. I'm 18 of the University of Maine deck. There we go. We always look at kind of headwinds, like what's driving the market forward, what's obviously a significant headwind. Clearly, we know the headwinds, but I'll start on the right-hand side with some of the tailwinds. We're seeing more attractive valuations. If we've seen kind of the valuations of a lot of these stocks, like the Amazons, the Apples of the world, have really come down into more historical norms. So we do think as that happens, there's probably some buying opportunities in the midst of this negative volatility as valuations continue to go down. Some of the tailwinds, like also is strong profitability. We've seen for the most part, retail otherwise have been fairly close in line to what their muted expectations were, but they're still growing. So for the most part, they've been in line, although we started to see more recently that certainly the likelihood of some layoffs are certainly increasing across the marketplace. And that's probably it's probably going to happen for the Fed to actually make a meaningful difference in the inflationary front. But then low expectations is kind of a funny way as a tailwind. But if the market is so down, there's probably some buying opportunities. They tend to oversell sometimes. And so with low expectations, we do feel like as if they create some opportunities in the marketplace. On the headwind side, clearly inflation is front and center. You think about the things, and we'll have a page after this to talk a little bit more about inflation, but it's been a really, really tough environment. The Fed is really, they don't have a lot of arrows in their quiver. So consequently, they are being pretty aggressive in terms of rate increases. It's going to be interesting. I think all eyes are on Jackson Hole, Wyoming today, where Chairman Powell is speaking. So that might have at least some precursor to what they might be doing in the next FOMC meeting. If you think about the consumer at the end of the year, consumer had pretty strong balance sheets. We were coming off of several years of stimulus, stay-at-home orders, not going on vacation, cooking more at home. The balance sheets were pretty strong, but as this inflationary environment continues, it's been a really tough strain on U.S. consumer, their budgets. You think about the increase in school supplies, increase in groceries, increase in gas prices. It's clearly eating away at the U.S. consumer. We saw housing, if you look at 30-year interest rates or 30-year mortgages are over 5%, I think now. And so that's created a little bit of a downturn in the housing market. And just the whole overall negative wealth effect when you look at your 403B balance at the end of 2021, you look at it now and I just want to ignore it for a little while. That's clearly part of this, of the effect of what we're under right now. The next page is just a really interesting chart. I wouldn't get hung up on the specific percentages because we could argue on the percentages, but clearly we were in an inflationary environment. No doubt we were, but the war in Ukraine exacerbated it. The pandemic has exacerbated it. This demand-driven inflation. All these things have been factors in in the increase in inflationary environment. The interesting chart at the bottom of the page is if you think about kind of where we were 2020, 2021 early, we had this a lot of stimulus, people were staying at home and inflation was fairly under control, but we started to see as the reopening started to occur, we saw some of that inflationary environment go up. But if you look at the non-shaded area, after it kind of opened up, inflation was relatively flat, or at least even if a little bit down. But then we had the reopening strain again. There was pent-up demand, and pent-up demand causes a natural increase in inflation. So we saw inflation in 2021 increase. But then we had this kind of period of time where it was in the non-shaded area. Inflation was relatively static, if not going down a little bit. Then we had the Omicron variant. Then we had the Ukraine invasion. And all these along the way, it's really just increased the inflationary environment. And so we think, obviously, a lot of factors, not just the demand-driven inflation, but clearly the geopolitical tensions, Russian invasion of Ukraine, all those things really has just exacerbated the inflationary front. Any questions thus far? Comments?
Yeah, could I just ask a question of you really quickly? If you had to look in, it's a crystal ball, but if you could see what would be the catalyst for a worst case market outcome, what would those catalysts be, and what would be the best case scenario, and what would the catalyst associated with that be?
Boy, that's a tough question. It's I'll answer maybe a different way, but hopefully they'll give you some feedback here. But we do think unemployment is going to have to go up in order for inflation to be ultimately to be reined in. And so I think if we don't see that, I think inflation will persist. If the Fed comes back and says, we need to raise rates greater than what we might think, that might cause a shock in the system, because they're saying they're seeing more data like the economy might be slowing even. They might be slowing, but not slowing enough to where the Fed would not raise rates further. And the flip side of that, the Fed comes back and says we need to raise our rates only a quarter basis points because we're concerned about the exacerbated slowing of the overall economy. That could create some shockwaves as well. So it's the Fed's in a difficult spot one way or the other. I do think we need to watch unemployment really closely, because I think that's going to be some tea leaves into what will probably portend to be a pretty volatile fall. I don't know, Mike, if you have any additional comments on that.
Yeah, I actually don't think we can overestimate the impact of the Russian invasion of Ukraine on the market. And I think in terms of the way you phrased your question, the range of outcomes, or the range of potential outcomes there, is so incredibly wide that I think if you were to see some type of positive resolution in Ukraine, it would be just an incredible boost to the markets. I mean, it's not that that's the only issue out there, but I would say right now that is certainly the biggest. On the other hand, you can even imagine the other end of the spectrum and the possibility of the outcomes there if it led to, obviously a world war. So I don't think, and I think this chart actually sums it up nicely, I don't think we can possibly overstate the impact of that Russian invasion of Ukraine. And I can't help but think, if you think of the timing of COVID starting to run its course, or at least the impact of COVID starting to run its course, if you remove that invasion from the equation, I can't help but think what the global economy would look like today. It certainly would be a much more positive picture.
I guess even another variant, if another variant comes out, I've had a couple folks recently get contracted with COVID again, and this particular time really took a toll on them. And so if that comes up, and then we have to have more restrictive shutdown orders, that could be certainly a negative catalyst in the marketplace.
Yeah. Thank you for that.
Barry and Mike, if you, I'd love to get your perspective, because you guys see it. The background 60-40 portfolio, you type that into Google and the question is it dead because of, where bonds had a pretty tough first half of the year at the same time as stocks did for the reasons you elucidated. And that's really kind of, we find that people are more out there asking about, well, what other opportunities are there? What other options are there? In the DC plan for the university, there's a direct held real estate portfolio that's people looking at that take a look at and see that it's done fairly well for that period of time and delivered some non-correlated returns.
Yeah.
So the question I'd have is, are other plan sponsors asking about that type of thing, alternative investment options, whether it's commodities or directly held real estate or multi-alternative strategies and that type of thing?
Yeah, I would say yes, but not on participant directed plans.
Okay.
Yeah, if you think about asset liability pools, NEPC will probably provide some context on that as well here in a few moments. But with non-participant directed plans, yeah, I mean, we're looking at alternatives, we're looking at private equity or private real estate, all as hedge against this inflationary environment. So that's been a key. And participant directed plans, it's difficult to think about, like, are there some asset class gaps, let's say, in the fund menu today that could combat this particular market? And probably there is, but we don't necessarily want to offer a commodities fund that is very risky. It has a very high standard deviation. And if you think about trying to, by the time we did it, is the period over? And so all of a sudden we have the commodities fund that is, starting to go negative. So it's a little challenging in a participant directed plan to really focus other than kind of like educate participants. And, it's a long-term retirement plan, and making sure that they understand that we're going to have difficult periods as we have right now. But TIA Real Estate has really been a really good hedge against that particular environment. They're a little bit of a laggard in this, so it's been a really good performing fund.
And frankly, the TIA traditional, again, I know that the 5%, in some cases 5.75%, still isn't keeping pace with inflation. I mean, it is having that option in a plan right now, especially, for people who are approaching retirement and really struggling with the fixed income space. I think, a really good option to have. It's not without its, issues specifically around liquidity and things like that. But again, if you're approaching retirement and you're looking at taking a structured payout from your plan anyway, I think it's actually this is a time when you can really take a step back and appreciate that as an option within a plan.
Completely agree, and that wasn't a question that was meant to think that I think that they should be added, and the university plan does have the brokerage window for somebody who wants to get at those types of things. But I was just curious. Thanks.
Yeah, I guess the other thing I will also, and I'll if we go to page 25 of the U main deck. One of the things we have noticed also is we've seen this kind of shift from growth to value. It happened probably late 2021. As of yesterday, just to give you an example, large cap growth on a year-to-date basis was down over 19%. Large cap value, on the other hand, was down a little over 6%. So there's been a 13%. So it's 13 percentage point difference between large cap growth mandates and large cap value mandates. And that's going to really carry forward into Mike's discussion on a couple funds that we have in the plan. I just wanted to leave you with this. We'd never go through this chart with you all, but it struck me on the S&P 500. If you look kind of midway down, it's a little challenging for me. I printed it, so I know this, so I don't need to put my glasses on. But the S&P 500, just to give you an indication, was down, almost 20% on a year-to-date basis. And obviously, we don't like that. We obviously would like growth. We would like positive performance. But then if you start going back kind of on the last three columns, the S&P 500 for the last 3 years, including the 20% dip, is an average return of 10.6%. Same thing if you go to the last 5 years, the average return is 11.3%. And then even more on the 10-year basis, the average return of the S&P 500 over 10 years has been almost 13%. And so if you were thinking back like 10 years ago in 2012, like if you guaranteed like you got a 12% return, 13% return for the next 10 years, I'd take that every day of the week. So while we don't like this, we're in this period of time, it's kind of a natural period of time in terms of valuations. Valuations got a little out of hand. So, and the long-term basis is probably we'll look back, we hope, in like 3 or 4 years and say, this is really a necessary part of the business cycle. Any questions before I turn it over to Mike? All right, Mike.
Okay, great. Thanks, Barry. Barry, I saw you smirk about maybe 3 or 4 minutes into your presentation. That must be when you realized we were both wearing the exact same shirt.
Yeah, we timed that so perfectly.
Well, I'm going to start on page 27. And again, just a snapshot of the Humane System plan. We continue to think it's a really well-structured plan in terms of having access to all of the, we believe, critical asset classes, from stable value all the way up to money market. And you have exposure on both an active and a passive basis. So we think best in class active, and certainly having a full suite of passive for people who are really focused on cost. In addition to that, Barry mentioned QDIA, your qualified default investment option, the Vanguard target date funds. Again, I continue to think a really prudent decision to have that as your QDIA. You know, we haven't had much progress since the last meeting on the Secure Act. I know we've talked a lot about that the last few meetings, and it did appear that the Secure Act was poised to be written into law, and we've had a little bit of a lag there in terms of when we hoped that would happen. We mentioned in the past that would have a huge, enormous impact on plans like yours by allowing 403(b) plans access to collective investment trust vehicles. And the Vanguard target date funds are a perfect example of where, you know, we would certainly recommend shifting into the lower cost CITs. And when you start to save even, you know, 2 or 3 or 4 basis points at the participant level on $2 billion in plan assets, it's really significant. So we're keeping a close eye on that, and hopeful, you know, that will occur before year end in 2022. From an asset perspective, you can see on page 28, about $1.7 billion in plan assets. We definitely saw a step back. That figure was closer to $1.9 billion as of the close of the first quarter. Really all market performance driven. We haven't seen a lot of step backs. I think if you go back to Barry's point and you look at, you know, where plan assets were in 2018, 2019, 2020, you know, we've certainly experienced significant, almost historic growth during the years of 19, 20, and 21. And so a little bit of a step back, but again, I think that we will, like most step backs, we will see a recovery at some point in time. I wish we knew exactly when, but I have no doubt that we'll start to see recovery. And frankly, we already have to some degree, as Barry mentioned, the S&P. This is reflective of the numbers as of June 30th, when the S&P was down 20%. We're down closer to 12% year to date. So we've obviously already seen some improvement there. The next several pages really just go through the assets, just looking at them a different way. A couple things I did want to point out here that we have 2 funds that are marked for review. They're relatively small holdings. The American Century Emerging Markets Fund is about 1.25% or 1.33% of total plan assets. And then the Virtus Midcap Value Fund is the other one. That's about 1.25% of plan assets. So we are going to talk more about those and those funds being marked for review. We do have a hold recommendation on both of those funds, but just wanted to point out, you can see they're relatively small holdings in the plan. And then starting on page 32, again, I won't go through these pages individually, but you can see we break down the plans in more detail from an asset perspective. From a scorecard perspective, your plan has actually held up pretty well in 2022. It's obviously been a very challenging market, but I think for the most part, the fund lineup has held up well. I think the theme, as Barry started to mention towards the end of his presentation, that the theme definitely is stylistic headwinds. I think if you look at the funds that are lagging in the short term, they're funds that have been faced with what we would call stylistic headwinds, not necessarily management issues at all. It's funds that did incredibly well during the growth years, during the high beta, high growth years. We're seeing some lagging performance, and frankly, funds that maybe lagged a bit during those growth years, we're starting to see improved performance. And that's something that we would expect to see. Just as an example of that, Harbor Capital Appreciation, which is your large cap growth fund, certainly took advantage of that growth oriented market, posting years of positive 33%, positive 54%, positive 16%, for 3 years in a row. On a year-to-date basis, they're down about 26% through yesterday, and they're in the 84th percentile. So again, we're seeing some lagging performance there, but it's consistent with what we would expect given the market rotation. We still believe that they're good managers, they make good decisions. Again, we just saw that towards the end of 2021, that market rotation back to value, back to quality. And so obviously funds that had more of a growth orientation, we're seeing some short-term lagging performance. So the theme is, high growth, high beta funds, lagging performance, funds that are more quality focused certainly are performing better. Couple other notes on this page: PGIM total return bond scoring an 82, so that continues to be in good standing. But as Barry mentioned, it has been a very, very tough year for bond managers, obviously for bond investors. The aggregate bond index, the AG actually, you may recall, closed down 150 basis points last year. It's frankly unusual for the AG to close down in the negative for a full calendar year. This year, the AG is down, as Barry mentioned, over 10%. Historically, the aggregate bond index has never closed negative for 2 consecutive years. I cannot fathom a scenario where that doesn't happen in 21 and 22, with it being down 10%. And frankly, at this point in the year, if you were to see a dramatic reversal in the performance of the AG between now and year end, that would actually probably mark some fairly dire things that are going on in the market. So again, we think it's going to be a tough year for bond investors. It certainly has been for PGIM. We still consider them to be a really good manager. Their long-term returns are solid, but again, it's been a very difficult market for bond managers to navigate. A couple other funds just of note here. You can see the Virtus Ceradex Midcap Value Fund is scoring a 70. That fund is kind of right on that verge of considered for termination. One thing that we always like to emphasize is that the scorecard, and specifically when we talk about phrases like marked for review and considered for termination, that's really just one part of the overall evaluation process. The scorecard was not meant to force action. Your investment policy statement doesn't state that when a fund is marked considered for termination, you will take action. It's really meant to promote, more dialogue. At this point, we continue to believe it makes sense to hold that Virtus fund. This is a fund that some of the longer term committee members may recall was marked for review several years ago as well, and then actually came all the way back, and at one point in recent years was scoring a perfect 100 following a couple of incredible years. This fund, again, has been faced with what I think are some stylistic headwinds. But another thing that has really hurt this fund in the short term is that it's a fund that has a dividend mandate. And so essentially what that means is by prospectus, this fund has to hold securities that pay dividends. Well, if you think back to the early COVID days, companies were slashing dividends and eliminating dividends for a period of time. Well, because of that mandate, what that does is it places the manager in a forced sell position where basically they were liquidating positions when they were down And frankly, a lot of those securities have come back very, very strong, along with the markets during the early COVID days. And so that dividend mandate was definitely an issue that caused a downturn in performance. And so the result of that, and it's not exclusively that, but that was certainly a big part of it, is that we're going on now a couple of years where the fund down in the 80th percentile, and year to date, it's down in the 95th percentile, down about 12% in absolute terms. So we certainly want to see improved performance, but one thing that we are trying to emphasize during this period is trying to show a little bit more patience where we think it makes sense, because again, we are in, not coming out of, but we are in one of the more unusual markets that certainly I've seen during my 30-year career. So we do still have a hold recommendation on that Virtus Ceradex Midcap Value Fund. That said, we're going to keep a close eye on it, and I wouldn't be surprised if maybe we're at least looking at some alternatives at the next quarterly review. Euro-Pacific Growth, we continue to have a lot of confidence in. It's scoring a 92. You can see the 3-year peer relative performance is below the 50th percentile. That's really the result of one bad year. Year to date, Europac is back up just outside of the top third, and the long-term numbers continue to look really strong as well. And that's obviously reflected in that score of 92. And then finally, some of the more aggressive asset classes, you can see the small cap space looks really strong. Emerging markets, which has been an area which frankly we've struggled with a bit in the UMaine plan, but the American Century Emerging Markets Fund just this quarter slipped into that marked for review category with a score of 76. And the 3- and 5-year performance has slipped below the 50th percentile. Again, that's been a really tough asset class. It's down year to date in the 80th percentile as well. So we really want to see some improved performance out of emerging markets. Similar to Virtus, we do have a hold recommendation. We think they're good managers. We think it makes sense, to continue to show some patience here. But just on a forward-looking basis, I think that we may be looking at some alternatives in both the emerging markets and the mid-cap value space next quarter. Again, the good news is if you look at overall your actively managed funds, those are two of your certainly the smaller percentage holdings. Overall, I think the actively managed fund lineup has held up really well during what has been a very challenging market. But we've got a couple funds that we really do need to keep a very, very close eye on. Questions on any of that? Or Barry, do you have anything else you wanted to add on those funds?
No, I guess the only thing with Virtus is they do have a slight kind of growth bias, even though they're a value fund. And I just described kind of the difference between growth and value for this period. So that exacerbated their underperformance.
Yeah. On the target date space, again, I mentioned earlier your default option, the Vanguard target date funds. We continue to believe those are amongst our top conviction choices in the target date space. If you're going into a Vanguard target date series, you're getting a well-diversified, professionally managed fund at a very, very reasonable cost that automatically de-risks as you get closer to retirement. I think you're really hitting the vast majority of investment principles, in a target date fund. And Vanguard certainly continues to be the leader in indexing and a leader in the target date space as well. Most of their vintage years outperformed the benchmarks in the second quarter. The shorter dated vintages like 2020 and 2030, we saw a little bit of lagging performance, but overall they have held up really well. And you can see that score of 91 is certainly a very good score in the target date space. So we continue to feel good about those funds as not just a default investment choice, but frankly, just an overall investment choice. And then finally, as we mentioned earlier, in the kind of capital preservation space, you do have that TIA traditional, the retirement choice contract, which is slightly more liquid than what you used to have, which was the retirement annuity. That fund is paying just some astonishing yields on a fixed income account right now, greater than 5% for most investors. I think again, it continues to be a really good option within the plan. Not that, you know, we would ever recommend anyone be fully invested in any one investment option, but again, I think if you're looking at diversifying your fixed income portfolio during a time when the bond market clearly is in a bit of turmoil, I think having access to that TIA traditional is a really good choice. And then finally, you offer the full suite of Vanguard index funds for people who want to structure their own index-based portfolio. And again, you're in the institutional share of all of those funds as well, thanks to your asset totals. May or may not impact the Secure Act legislation, may impact the institutional index, but you know, not going to likely have a huge impact on the suite. It would have more of a dramatic impact on the target date funds and some of your individually actively managed funds. So again, overall, I think that the plan has held up pretty well during what has been an incredibly difficult market in 2022. Your average plan score, again, this isn't what I would describe as a hugely meaningful figure, but I do think it's, you know, a good figure to take into consideration. Your overall average plan score is very, very strong with a score of 94. Again, I think we have a couple funds that we certainly want to keep a close eye on that are trending down from a score perspective. But again, just to point out the impact of the market, the COVID market on the Virtus Ceridex fund, you can see we had 6 consecutive quarters where that fund was scoring a perfect 100, and then 4 quarters where it was scoring a 97. And then again, really thanks to some short-term dramatic underperformance, we saw it really go down into that marked for review and all the way into that considered for close to that considered for termination category in just a couple of quarters. So hopefully we'll see, you know, the same type of recovery with that fund that we've seen in years past. We do think that they're a good manager and a quality manager that really has just faced some incredible stylistic headwinds over the last year or so. And I'll pause there and see if you'd like me or us to go into any more detail on any of the individual holdings.
Hey, Mike, not on the individual holdings, but staying future oriented, and I know we're in a period of market uncertainty with real potential of the continued rate increases. What should we be thinking about as we start considering there's a real probability of rate increases, and we start thinking about next quarter in terms of funds or manager lineup? Do you have any recommendation or what you're seeing from other customers that may serve us well?
Yeah, I mean, I think it's a great point. I mean, I think if we go back to just the high level structure of your fund lineup, and I made this comment earlier that I do think it continues to be a very well structured fund lineup. You have all the critical asset classes covered, both active and passive. You have a couple specialty asset classes like emerging markets as well. And in addition to that, to Jim's point, you do have the self-directed brokerage account. So if you have individual investors that are looking to diversify their portfolios beyond these core holdings, they have the opportunity to do that through the self-directed brokerage, which to me, that's the point of the self-directed brokerage, is that, you know, if you feel like you need some additional diversifying asset classes that may not be appropriate for the core fund lineup, but are appropriate for you as an individual investor, I think that's the beauty of that self-directed brokerage account. I don't think we need to be thinking about any structural changes. I mean, certainly there are some individual funds that we need to keep a close eye on, but I don't think there's any gaps. There's very little overlap, but I also don't feel like there's any gaps in your fund lineup at all. I think we're just going through, you know, a unique market period. And I think for most investors, kind of staying the course and focusing on good, sound asset allocation, diversification principles, not panicking, recognizing that, you know, markets do periodically go through down periods. But if you go back and you look at, you know, throughout history, some of the best years in the market, you know, have been the years following these down cycles. So anyway, long-winded answer to your question, which is no, I don't think we need to be making any changes, you know, in terms of the structure of the fund lineup.
I get the one thing I would add is maybe it's a good opportunity to remind plan participants that you do have a resource out there with TIAA. If they do start to panic, don't do anything rash. At least have a phone conversation with TIAA. Hopefully they'll can get them a little bit off the cliff. But even TIA traditional, the CREF inflation linked bond. So we do have that doesn't. We're not immune for negative performance, even in the TIPS area, but they've only been down about 7 or 8% on a year-to-date basis. So you can't hide, but it could lessen the blow a little bit. But I think it's a good reminder for people to reach out if they're concerned.
Any other questions for us on the funds, the fund lineup, the markets, anything that we covered?
Given the rising interest rate environment, one would assume that the US dollar would potentially strengthen. And how does that affect some of the international investments?
It's a headwind for sure. It absolutely is a headwind. You have currency risk associated with some of these things. So I do think that it'll work itself out, but the short term, probably that will just exacerbate some of this negative volatility, especially on the international front. No doubt.
Yeah, and that has had a slight impact on the Vanguard target date portfolio. Vanguard took an overweight international position or non-US equity position going back 3 or 4 years, well, along with some other target date providers. But the theory going back was that the US markets were really overpriced, that there were more opportunities in the international markets, and that thesis just really hasn't played itself out the way a lot of people expected it to. If you go back and even on a year-to-date basis, S&P down 12, the EFI is down 17. You go back and look at 3-year averages, to Barry's point, S&P still up 10, almost 11%, the EFI closer to 2 or 3%. So it definitely, that international exposure does cut across not just the individual international funds, but the target date funds as well.
Yep. Good question.
Anything else? Okay, well, thanks very much, everyone. If there are no other questions, we appreciate your attention today, and we'll look forward to seeing everyone next quarter.
Thank you, Mike and Barry. Appreciate the perspective on the markets, and thanks for your diligence in reviewing our plan menu.
Absolutely. Thank you all. Have a great day.
Take care. I see Kelly on. Hey, Kelly.
Good morning, everyone.
That was perfect planning. Walked in right at the right time. So I'm going to pass the meeting over to you, Kelly, for the performance reviews of the 3 portfolios: the MIP, managed investment pool, pension fund, and operating fund.
Okay, great. So good morning, everyone. Just a few housekeeping items before I go into performance. Today, in addition to performance, I'm going to be going through a recommendation on an international equity manager that is fossil fuel free. And then at the end of the agenda, I'm going to be doing a private equity education with all of you. My colleague, Josh Beers, will be joining the Zoom. I told him to join around 10:30 in case we're running early. So if you see another name come in, that is my colleague, and he'll be listening in until it's time for the private equity session. So with that, I will share my screen. Okay, can everyone see my screen okay? Okay, I see a lot of head nodding, great. So I know CapTrust, I did listen to the majority of their presentation and heard your questions around markets. So I'm not gonna spend too much time kind of going over the bad news that we had in the second quarter with the negative returns. But I did want to stop on this page, NEPC's portfolio positioning views, and walk you through that and kind of how it relates to your portfolio. So we put this page together, really, we call it a general page. Not everything on this page is applicable to all of our clients, but generally, these are our views, and it's, my responsibility to say, how do these views apply to the University of Maine portfolios, and do I have any recommendations based on these views? So the first one is, we're underweight risk in terms of our views. We've had, a difficult second quarter. July was better in terms of equities up, bond yields had fallen. So, your July performance looks pretty good for the 1 month, and then a little bit more volatility in August. But given all that, we're still very uncertain about the markets. Given inflation, given negative GDP growth, given the future of what the Federal Reserve is going to do with rate hikes around trying to get up to that higher inflation level. And we think there's some ways to go with future rate hikes. So given this, when we look across your 3 portfolios, as we work with Tracy to rebalance for cash needs or benefit payments in the pension plan, we are underweight equities. For example, in the managed investment portfolio, we're underweight by about 4% versus targets. In the pension, we're underweight about 2%, and then in the operating fund, about 3%. So taking a little bit more cautious view in our rebalancing recommendations. As a reminder, you do have targets to equities, but there is a range around that in your investment policy statement. So we are well within that range and not anywhere close to the bottom end of the range, but just a little bit below targets. Given inflation, one of the areas that we are positive on is value equities. When we look at your portfolios, specifically the MIP, there is value equities in the portfolio. So I'm not recommending making any changes there. With the exception, I would say is, when we talk later about the international equity manager, Silchester, they do have a little bit of a value bias. And so given the inflation, value equities tend to do a little bit better. We have been seeing that. I know CapTrust quoted you the figures of what large cap growth is down versus value. So value has been holding up a little bit better year to date, but no new recommendations in terms of new managers to put in the portfolio. We're also keen on making sure there's enough liquidity in the portfolio. And this is for a number of reasons. One, for example, the pension plan, making sure there's liquidity to raise money for benefit payments. And the operating fund, making sure there's liquidity for the spending needs, and same with the managed investment pool. I'll have to say that there's no issues with liquidity across any of the portfolios. Later, we will be talking about private equity and a little bit of education around that in terms of the managed investment pool. And I think even if the committee decides to go further down the track of doing private equity in the managed investment pool, there is still ample liquidity in the MIP to accommodate that and any future spending. Right now, when we look at the managed investment pool, there's 93% of the portfolio that could be liquid monthly or daily. The other reason why we want liquidity is to take advantage of, market dislocations. And if there is a market opportunity, to make sure that we're liquid to take advantage of that. And again, the portfolios have that liquidity. And then lastly, we've seen a rise in rates, a rise in credit spreads, and specifically on the short end of the curve. And so for some portfolios, short-term credit is an area that we're positive on. I would say for your portfolios, I think we have a decent amount of short-term credit, whether it's through a dedicated core bond manager or if it's through BlackRock, your more flexible fixed income manager that does go shorter duration. So I don't think there's a need to add an additional manager in terms of short-term credit, and we can get that through some of our flexible mandates that we have today. So I'll just stop there, see if there's any questions on our views, or if you have any questions about, what you heard from CapTrust in terms of the markets, or anything else that I could share in terms of our market perspective. Okay, hearing none, I'm going to turn into the performance, and I'm going to start with the operating fund. I'm going to go through the executive summaries for each pool of assets, and then I'll dive in a little bit more to the managers, and there's a lot of manager overlap across the 3 pools. But just to start here with the operating fund, you can see in the top left here at the end of June, we had about 317 million. When I look at this at the end of July, it's about 310 million, and that's more so from outflows than it is from markets, because we did have a positive July. The operating fund was up 1.2% in July. But if we go back to the quarter, you can see it was a difficult quarter for the operating fund. If you remember, this fund is, about 30% in, money market or cash. It has a decent chunk, 44% in the income pool, which is mostly fixed income, different types of diversified fixed income. So with rising rates, those fixed income assets did decline. And then even within the total return pool, again, this is diversified. It's not all equities, but there is some equities in that pool, again, bringing some negative returns during the quarter. You can see that when we look at the composite, which is the actual return for the fund versus the allocation index during the quarter, those two numbers were in line with each other. That shows really an aggregate when we look across managers versus their benchmark. There was neither value add or detraction during the quarter. Longer term, over the 3, 5, and 10 years, you can see that there is a difference between those two numbers, and there has been manager value. In terms of recent actions, there is none to report on, and then the recommendation later in the agenda about the international equity manager, recommending that you consider hiring that manager for the operating fund as well as the MIP. Another item that I've put into the deck, you've seen this ESG dashboard last quarter for just the MIP, but given that you all approved incorporating ESG into all the funds, so adding the operating fund and the pension fund to your investment policy statement last quarter, I've added this page in for both the operating fund and the pension. And so what you see here for the operating fund is at the top chart here, we're looking at all of the investment managers and seeing one if they're a PRI signatory. And that means that they've signed on with the principles of responsible investment and they're making best efforts to incorporate ESG through their investment process and be good stewards of ESG. You can see 91% of your managers in terms of assets are signed on with the PRI, so very strong. And then ESG integration, what does that mean? We look at all of your investment managers in the fund, and NEPC has our proprietary rating system for ESG. And it starts with 1 being the best, then there's 2, 3 is neutral, 4, and then 5 is essentially the worst rating a manager can get. And so what we do is we take your managers and we say all the 1, 2, and 3 rated managers, so managers that are incorporating ESG in some level, whether it's from neutral to the highest integration, 80% of your managers in terms of assets are rated 1, 2, or 3. So even though this portfolio hasn't had an ESG focus in terms of its investment policy, some of the managers that have gone into the MIP as it was focused on the ESG policy have trickled into the operating fund, not because of ESG, but because we think they're highly rated managers from an investment perspective. And then down here at the bottom, you can see kind of how those managers rate. So most of them are rated 1. We have a couple rated 4. And typically are passive managers, so managers that are passively managed to an index we rate 4 because there's really no ESG incorporation at the investment level. It could happen at the firm level, but not at the investment level. So overall, good standing for the operating fund in terms of ESG. Turning over to the pension fund, you can see that assets were a little over 20 million at the end of the second quarter. That's about 21 million at the end of July. The pension fund was up 3.7% in the month of July. So these numbers do look a little bit better, but you can see for the quarter, the pension fund does have more equities than the operating fund, so the returns are lower than the operating fund. During the quarter, there was some value add from the managers in aggregate when you compare the composite versus the allocation index. And then when we think about from a fiscal year to date perspective, your fiscal year end is 6/30, you can see that there was quite a drag on a fiscal year to date basis, down 7.8%, given really what's happened in the first quarter and the second quarter. So did not meet that actuarial rate of return target in fiscal year to date 2022. No actions to report on, no new manager announcements. We always rebalance this fund on a monthly or every 2-month basis to raise cash for benefit payments. And those have been going out as planned. And then with the pension fund, we have no recommendations today. You'll see later on that that international equity manager, from a asset allocation perspective, could fit in the pension fund in our equity section. But because assets are below 25 million, this fund is not considered a qualified plan, and it cannot be, some commingled fund managers cannot take these assets because of the asset size. So there's no recommendation here with that. For the pension ESG dashboard, very similar to what you saw in the operating fund. High PRI signatory base across the board, high ESG integration across the board based on NEPC's ratings. And then again, very similar in terms of ratings here. A lot of the managers are rated 1 or 2. We do have passive managers that are rated 4 in the pension fund, and then 1 manager that is not rated, and that is Principal, your real estate manager. We just have not done a rating on that manager at this point in time. In terms of the managed investment pool, assets about 335 million at the end of the quarter. That's up to about 350 million at the end of July. So it has improved. Asset allocations in line with, policy ranges. Again, I mentioned earlier, a little bit underweight equities, but within policy ranges. One thing you'll note is that the asset value did decline during the quarter, and we did see about 57 million or so in redemptions out of the managed investment pool, with Maine Maritime leaving the pool of assets. And so that was the majority of the decline, and then investment losses of about 39%, or 39 million, sorry. And you can see that up here in the top right with the planned performance, down 10.5%. Again, the managed investment pool has a very long-term horizon, more equities than both the pension fund and the operating fund. Again, so that is why you see those numbers a little bit stronger down compared to the other 2 pools of assets. During the quarter, we did have some manager value add of 10 basis points if you look at against the versus the allocation index. And then on a fiscal year to date time frame, you can see it was down about 12.5%. Just talking about rankings briefly, we do rank this pool of assets versus other endowments and foundations of similar size. The rankings from the quarter, year to date, and fiscal year to date is just slightly below median, around the 60th percentile. So it has improved compared to the longer term results. I think one of the key differences when we look at the endowment versus other peers is that peers do have an allocation to private equity, private real assets, and we'll go through that when we get through the education. And when we look at a quarter like this most recent quarter, your public equities are being marked down, whereas private equity hasn't seen that markdown that's fallen yet. So other endowments and foundations are actually seeing quite positive returns given the private equity lag from that piece of their portfolio. And that is one of the key metrics that kind of drives some of these rankings, given the difference in asset allocation. And then I'd also say in terms of the composite versus the allocation index over the longer term, more recently, the year to date, the fiscal year to date, a lot of that has been driven by some growth managers that have underperformed. And I think you heard a little bit of that from CapTrust. And it's also been driven by 2 managers that we've recently terminated, Morgan Stanley and Kabouter, which had been significantly underperforming their benchmark. So those managers are now out of the pool of assets. And so hopefully we don't see as much drag going forward. You can see in the recent actions, similar to what I was just talking about, Kabouter was terminated and replaced with Axiom. Morgan Stanley was terminated and replaced with SSGA EFI Index, and the committee did approve that. And then the recommendation, we'll talk about the international equity fossil fuel free strategy. In terms of the MIP, the dashboard is very similar to what you saw last quarter. High PRI signatories across the assets, high ESG integration. You can see 6 1-rated managers here, 6 2 and 3 rated managers. So very highly rated ESG managers across the board. And the only non-rated manager is Landmark, which is one of your private equity investments that you've made a long time ago. And again, it's just has not been rated at this point in time by NEPC. It doesn't mean that it couldn't possibly be ESG incorporated into their investment process. It's just that we don't have a rating on it this time. I will stop there before I get into some of the managers. Are there any questions from the group? Okay. So I'm going to start by doing some manager overview. And these are the managers in the managed investment pool. A lot of these managers carry over to the other funds. So that's why I like to start on this page, because it does incorporate a majority of your managers. Couple things that I want to point out is that within the domestic small mid-cap space, you have Westfield and DFA, and these managers continue to do a nice job paired together. We have Westfield as a growth manager and DFA as a value manager. And when you look at those two managers versus the broad Russell 2500 benchmark, you can see over the quarter, year to date, and even longer term that these managers have done better than the Russell 2500 benchmark and have ranked above or at median for the most recent quarter, but above median longer term. So we like the pairing of those managers. Walter Scott is your global equity manager. It's a newer manager. You can see the shorter track record because it's only been in your pool for a little bit more than 1 year. It did get off to a rocky start just because it does have a slight growth tilt to its process, which has been underperforming. You can see the most recent quarter outperforming the benchmarks, so coming back, and then happy to say in July when we did see the reversal of growth and value, they did outperform. SSGA and Axiom, again, I mentioned, are new in the portfolio, so we don't have any performance to share with you there. As time goes on, you'll start to see performance from those managers. But J.O. Hambro, one of your international equity managers, similar to Walter Scott, does have that growth bias, and has been underperforming because of that. We'll talk a little bit later about Silchester. They're more value, and I'll show you some stats on how they'll pair well with J.O. Hambro if you do move forward with them, which I think will be nice for the portfolio. Do want to note here, just because it is an error, and I just want to call it out, we'll correct it going forward. But one, we added these ESG ranks to all your managers, and SSGA EFI is a 3 rated manager. We coded it in as 1. I just want to make sure you know that that's a passive manager and it's 3 rated. So that we'll fix that going forward. But I didn't want to call that out because later in our discussion, we'll talk about moving potentially from SSGA, a 3 rated manager, to Silchester, another 3 rated ESG manager. And then in terms of emerging markets, Aberdeen, when you look at their year-to-date figures, a lot of this underperformance is coming from really the first quarter with some of their Russia holdings, more in line with the benchmark this recent quarter. But the first quarter was difficult for them as they did hold some holdings, that were impacted by the Russia-Ukraine conflict. And then Mondrian continues to be a solid manager, outperforming, has a little bit more value tilt, so did really nice during the quarter. In longer term has been ranking well versus other emerging market peers. You can see the high rankings, 23, 12, and 55. Another area of the portfolio that has continued to do well and has done well over the long term is your fixed income portfolio in the MIP. If you look at this total fixed income line in the blue, right below it is the Barclays aggregate. So that's the broad benchmark for fixed income. You can see over all time periods that your fixed income portfolio has outperformed the Barclays aggregate and has ranked well versus other fixed income peers. A lot of this is due to some of the diversification that we have. This is not just a core bond portfolio. We do have some TIPS exposure. Certainly, more recently, like the recent quarter, TIPS did underperform the aggregate. But you can see long-term it has added value versus common fund. Also, BlackRock Strategic Income Opportunities longer term has done nice and has added some value. And that's a manager that gives you a little bit of exposure to high yield and emerging market debt and short-term credit and all diversifying credit type assets, which has been nice. And then Bain, has been additive to the portfolio in terms of their absolute returns. Newton continues to do well. You can see their rankings are all above the 50th percentile. During the recent quarter when we had equities down and fixed income down, Newton was only down about 2.5%. And again, this is a manager that has a high ESG focus and is really in the portfolio to help diversify in some of these down markets, which they did do. And then Lighthouse is another one of those managers. It's a hedge fund, more equity, long, short focused, that is in the portfolio to diversify when we do see these declining equity markets that we've seen in the first 2 quarters of the year. They're positive year to date, which is good versus just the S&P 500. But then when we look at their benchmark, which is a benchmark of peers, they're also outperforming quite significantly. So no concerns with any of these managers. The recommendation today is, maybe a recommendation, to improve the portfolio from a fossil fuel free perspective. It's not because we have any concerns with the current managers. And then some of the last comments I'll make is just on the pension fund. Just want to note here that, all the other managers are the same with the exception of Principal. We do have some exposure to liquid real estate in this portfolio. This is an open-end real estate fund. You can see their performance has added value. If you look on a year-to-date basis, real estate's up 10%. 1 year, it's up almost 28% when markets are down. So it has been a good diversifier for the pension fund and another way to get some income into the pension fund for the benefit payments. And then lastly, on the operating fund, wanted to point out PIMCO All Asset. This is another manager that you didn't see in the other 2 pools of assets. Longer term, they have done well. If you look over the 3, 5, and 10 years, if you looked at this last quarter, all trailing returns would have been great, as they have exposure to commodities, other emerging market assets, fixed income assets that are very diversifying. This most recent quarter has brought down the year-to-date results, given what we've seen across markets, but still a strong manager, and the long-term results are quite good. So I will stop there and see if there's any questions on performance before possibly turning over into the international equity recommendation. Okay. Kelly, would you like me to move to the next section?
Yes, please.
Okay. Give me a minute as I get there. There's always additional information in the back of this deck. There's manager pages, more performance pages, risk return pages. I typically don't go through them, but we do put them in the back of the presentation for you. All right. So let me just go back.
Kelly, I'm sorry, maybe just while you're looking, quick question. What's the timetable for your review of managers? Do you do it annually? How often do you do that?
Every day.
But in terms of making a change?
It depends. So a manager has to have, something change with their investment process, something happen with a portfolio manager leaving, like a team change, loss of assets at the firm or loss of assets in the strategy. Those will trigger due diligence events, which will trigger me to look at the managers, review the managers, and see if I would recommend a change to you. And so not always do those types of events mean that we need to make a change. More recently, with the international equity managers, Kabouter, we were seeing significant underperformance, loss of assets, slight change in their investment process. And so that triggered me to say, it's time to redeem from Kabouter. So we're always looking at it, but we're not trying to change these managers very frequently. I like to give them, time to, have their strategy prove true, usually 3 years at a minimum to give the manager time, because we're in and out of cycles all the time. And sometimes that particular cycle is not advantageous for that.
And is their fossil fuel investment part of that review?
No. So this is Silchester that we're going to talk about is a manager that has always been 1 rated at NEPC. It's been closed. their flagship international equity strategy has been closed. From time to time, they'll say we can put investors on a wait list. It could be 2 or 3 years before, we say you can come into the strategy, but it's been a one-rated strategy at NAPC. I want to say at least since I've been at NAPC for the last 15 years. It's just been hard to get into. They recently came out because of investor interest in saying, we're going to launch an exclusion trust. So it's going to be taking our flagship strategy with the same investment process, the same team, everything that's one rated at NAPC, and we're going to exclude fossil fuels from our flagship product and have it available for those investors that are interested in fossil fuel freeze. And it's launching October 1st. And I thought, given one, that this is a highly rated manager that has a value tilt that would pair nicely with what you have in the portfolio, overall is great. And then the added benefit that it does exclude fossil fuels, given your new mandate, would be something that you all may be interested in. So that's why I'm bringing it today. So to start, on this page, I went through, I think, most of these bullet points. I think what I want to say is that the Silchester strategy, from both the flagship product and the exclusion product, from our perspective, does not have a high ESG integration. So I did want to point that out to the committee. It's rated 3. So it's neutral. So it doesn't mean it's bad. The recommendation is to move from an index to Silchester, and the index is 3 rated too. So you're not going up or down from an ESG rated strategy. And then in terms of tracking error, so when we're thinking about a negative screening product and screening out fossil fuels, there are times that this product could do better or worse than the flagship product and better or worse than the index, depending on what's really happening in the energy markets. So there can be a little bit more tracking error in this product than the flagship product. So I just want the group to be aware of that. Overall, we've underwritten the product, and we do not have a different view on the exclusion trust versus the flagship product. So both are 1 rated. In terms of Silchester, we have the overview here. Things that we like about Silchester is, they really focus on intrinsic value. They have a high experienced team. I think the assets under management in the strategy is around 40 billion. So, a lot of investors in the strategy. I think there's interest of about 1 billion the last time I spoke with Silchester in the exclusion trust. So you would be going into the exclusion trust, with a pretty, sizable assets under management. The Silchester only focuses on this one international equity strategy. So it's not a firm that has a bunch of strategies where the team needs to manage across different types of styles or large cap, small cap. It's just this one strategy. So it really allows them to build the expertise, really research those companies. They tend to hold on to their companies, low turnover approach. And while, even though it's a low turnover approach, they're still always researching other companies and kind of having that backup list. So if they were to sell out of one of their current holdings, they have a strong buy list for them to look at, given the research. The portfolio would be about 100 to 200 names. It is an all cap portfolio, so it can do large cap, mid cap, and small cap, which we like that flexible nature. And they do have the ability to invest in some emerging markets. And it's typically, around, maybe 10 to 15% or so. In terms of performance expectations, this manager has very strong downside protection. So they tend to protect when the market is down. And they do, even when the market is up, they do tend to perform then too. So I would say they would lag kind of in the first 2 quarters of this year when we're seeing more of the growth equity rally. So growth momentum type markets is a market that they would underperform in. when we think about them pairing with J.O. Hambro would typically outperform in the growth and momentum markets. Silchester would underperform, so it would be a nice balance to each other. In terms of performance and characteristics, we have listed here the trailing returns as of June 30th, the Silchester flagship product. So that is the product that does not exclude anything. You can see their returns over all time periods has outperformed the MSCI EAFE index, which is their benchmark. And then we've also profiled the exclusion trust, which is the fossil fuel free strategy. And you can see that more recently, that fossil fuel free strategy has outperformed the flagship, but longer term. And again, these are back tested results because the portfolio isn't up and running yet, but based on the back test results, you can see it's underperformed, but not by a significant amount, and it's still outperformed the MSCI EAFE index, which again is something that we like to focus on. When we're excluding something, we want to ensure that we still can outperform the market. In terms of carbon intensity, we have the Silchester flagship portfolio in this pinkish purple here, which does have lower carbon intensity than the MSCI EAFE index, and pretty much in line with the EAFE index ex fossil fuels. So the flagship strategy, even though it doesn't exclude fossil fuels, looks pretty good from a starting point, but you can see the exclusion trust looks much better from the carbon intensity of their holdings. Over here on the right in the middle is just the companies that at this point in time that they would be excluding. So it's about 7% of the portfolio that they would be excluding. And they will exclude things, coal, oil sands, tar sands, utilities that generate 25% of their electricity from coal and oil. They look at different sources for the companies that they're going to exclude. The first one is they're going to look at that Carbon Underground 200 list, which I personally thought worked well with the system because that is the specific list that we've stated in our investment policy statement that we're going to work towards excluding. And then they're going to look at other things such as Sustainalytics, their proprietary research and other databases to look at companies and their fossil fuel exposure. In terms of implementation, as I mentioned, this can be implemented from our perspective in both the MIP and the operating fund. The pension fund is not a qualified purchaser at this time, given the size of assets. But if that grows in the future, we could potentially consider it for the pension fund. For the MIP, I mentioned that our recommendations to replace the MSCI EAFE index, which I know you just funded as we terminated Morgan Stanley, but Silchester could replace that EAFE index, and it pairs well with J.O. Hambro. I show a couple charts here, and so what I want to show is that your current portfolio is listed here in the middle of the page, where when we look at the alpha and the tracking error, or the return versus the risk, you can see that, it has, a good alpha, modest tracking error. If you did JO and Silchester, based on Silchester's alpha profile, you have the potential ability to see higher alpha with similar tracking error. So from that perspective, I think it pairs well in the portfolio. And then we also like to look at the alpha correlations. And as I mentioned earlier, J.O. Hambro will do well in a growth and momentum market. Silchester will do well more in a value market. And you can see the negative alpha correlations. From our perspective, negative is good. If these two managers had a very high alpha correlation, that means they're both going to go up at the same time. They're both going to go down at the same time versus a benchmark. And you don't always want that. You want to make sure your portfolio is diversified across strategies, having managers that do well in certain markets, have managers that do well in other markets. In terms of the operating fund, you don't have a lot of equities in the operating fund. The equities that you do hold directly is with the Vanguard Total World Stock Index, which is invested, 62% US, 27% international developed or MSCI EAFE, and 11% emerging markets. We think if you took that 24 million and took 65% of it and implemented it with the S&P 500 index and used SSGA similar to the managed investment pool, and then hired Silchester for the other 35% of that 24 million, you would get kind of close to that split of what Vanguard is today. So you wouldn't be materially changing the profile of how your equities are currently invested. You do lose a little bit of emerging market equity exposure, but remember, Silchester can invest in emerging markets. And then we also do have PIMCO and Newton and even Lighthouse that can have exposure to emerging markets. So there'll still be emerging markets in the portfolio through the flexible mandates, but it might be a little bit lower than what you have today. Overall, the fees will increase, but the numbers that I showed you are all net of fees. So the alpha numbers are net of fees. The performance numbers that I had went through versus on this previous page are net of fees. So even though the fees are higher, Silchester's fees are 1% annually versus, SSGA and the MIP at 3 basis points and Vanguard at 8 basis points in the operating fund, the alpha potential from Silchester could outweigh those additional fees. So I will stop there and see if there's any questions from the committee on Silchester or, thoughts on the implementation. Just take everyone's pulse and kind of see what everyone's feeling.
Kelly, from an ESG perspective, the transition to Silchester is basically neutral. We're not going to see any lift or any detraction. I mean, based on current situation, it can change in the future. Their posture as we move into the future with this exposure, they're historically, do they have any favoritism towards ESG?
Silchester?
Yes.
A little bit. It's not highly integrated. And even, the fossil fuels free strategy that they're launching, from my understanding, it's more based on client interest, not necessarily a view on the fossil fuel industry themselves. So it's more for client interest. So again, more neutral terms of ESG. And I think when we had the discussion last quarter, when we were talking about divestment, it's not that every ESG manager is going to be divested from fossil fuels, and not every fossil fuel free manager could be high ESG rating. It all depends across the board. So the two of them are sometimes separated. They're not always one for one.
Kelly, is Silchester based in the US or is it based in Europe?
Good question. I believe they're based in London. I'll have to get back to you on that, but I believe their presence is out of the UK.
So does that cause any problems with our portfolio to have a manager based in the UK?
No, Walter Scott is as well. So they have products available for US investors, but the portfolio management team can be based, globally. There will be currency, not at the fund level, but the underlying investment level, as things are translated back to the US dollar. There's currency in international markets, no different than what you see with J.O. Hambro and SSGA EFI index today.
Kelly, thanks for the presentation. Very thoughtful, and it was great to hear. From an expected return viewpoint, when you're looking at the asset allocation for emerging markets and developed markets relative to the U.S. markets, where do you see those expected returns? Are you feeling like there's going to be higher expected returns overseas over the S&P, or what's your view on that?
Sure. I can follow up with the exact expected returns. We just came out with our 6/30 capital market assumptions, and they have gone up recently because of the equity market decline. So I'm going to give you kind of a generalization, but the U.S., let's say the expected returns over the next 10 years are expected to be 6%. International markets could be 6 or 6.25. Emerging markets probably more around the 8% range. So we are favorable on emerging markets for the long-term growth potential. So we do have a higher expected return for emerging markets. We are favorable on the US. Our return expectations has come from building blocks, so valuations, dividends, inflation, et cetera. So the return's lower than emerging markets, but we are favorable on it. We're less favorable on international developed. So when you think about, how you can invest in equities globally, and you look at the MSCI ACWI index, we prefer about 60% to the US, 25% to the international developed, which is lower than the ACWI index, and about 15% to emerging markets, which is slightly higher than the index. So, and in the managed investment pool portfolio, the weightings across your equity managers are reflective of that. About 60% to US, 25% to international, and 15% to emerging.
I would assume, Kelly, even though it's a UK operation, that there are no investments in Russia and other countries that might be banned by the US.
This is mostly international developed. So I don't know if they held any Russia in their emerging market, small allocation that they have. I can get back to you on that. But so I don't know if they're impacted by Russia, but highly unlikely that they were impacted.
I just hate us to go out of fossil fuels and go into an investment in Russia and get some more feedback. That's
right.
all.
Any other questions, comments for Kelly?
I'm doing that kind of awful research on Wikipedia. They are based in London.
Thank you.
But their portfolio companies don't look like any of them are Russian, a lot of Asian. And they were famous because they prevented TVB's share buyback program, which is kind of interesting given where the Inflation Reduction Act is.
Interesting. So without further ado, thank you, Kelly, for the performance reviews on our 3 portfolios. And thanks for your detailed review of the International Equity Manager recommendation. So at this point, I will read the text of the proposed resolution that the Board of Trustees, acting through the Investment Committee, approves the following investment manager change: to terminate SSGA MSCI EFA index and replace it with Silchester Exclusion Trust for approximately 5% of the total MIP portfolio assets, and terminate Vanguard Total World Stock Index and replace with SSGA S&P 500 Index non-lending for approximately 5% of total operating fund assets, and Silchester Exclusionary Trust for approximately 2.5% of the total operating fund assets. Can I have a motion?
So moved.
So moved by Trustee Bartholomew, seconded by Trustee Riley. And I'll transfer that to you, Ellen, to take a roll.
Certainly. Trustee Bartholomew.
Yes.
Trustee McMahon.
Yes.
Trustee Martin.
Yes.
Trustee Riley.
Yes.
The motion is carried.
And I believe at this point we go into the private equity education. Ellen, just a quick question. Do we continue this in the meeting, or do we end the meeting and do the education after?
The way the agenda has been established, it is part of the public meeting.
Okay. With that being said, would everybody benefit from a 5-minute restroom break or just get up and stretch?
Absolutely.
So moved.
Excellent. I was hoping somebody was going to agree with me because I can't wait any longer. So let's take 5. Let's try to be here by 10:46, 10:47-ish.
Okay, great.
It looks like almost everybody's back, Kelly.
Excellent, excellent. So let's go ahead with the private equity education.
Okay, great. So the last time that we spoke about private equity was in 2018, where we went through private equity education and discussed, what an allocation could look like, how it could be implemented. And we're going to do that again today. I think, as most of you know, typically when I go through the managed investment pool performance, I do always make a comment that sometimes some of the rankings can be a detractor because peers, have an allocation to private equity and the nuances of that. We do think private equity can make sense for the managed investment pool. We're big proponents of investing in alternatives, specifically for endowments like yourselves. And so we'll go through that presentation today. Before I share the screen though, I did want to introduce Josh Beers. He's our Director of Private Equity at NEPC. So I was going to have him introduce himself, say a few words about his background, and then we'll go through the presentation. So Josh, I'll turn it over to you to introduce yourself.
Hi, everyone. Can I just show a thumbs, or Kelly, give me a thumbs up if you can hear me. Good. Hi, everyone. I'm Josh Beers. As Kelly said, I head up our private equity team here at NEPC. I've been with NEPC for 4 years. But prior to this, I was at Liberty Mutual, investing off their balance sheet for about 10 years, solely focused on private equity. So almost all of my professional career has been in the investment world, and the majority of that has been investing in private equity. While towards the tail end of my career at Liberty, I did really focus on venture and growth equity strategies. And then when I came over to NEPC, one of the first things that I was hired to do was lead the effort here to start building out venture and growth equity for our clients' portfolios. And then that morphed into becoming head of the team last September. So nice to meet you all. Really happy, excited to be working with you all, potentially on a private equity portfolio here.
Great, thanks, Josh. Okay, I will share my screen now. Let's see. Okay, can everyone see that okay? Okay, I saw the thumbs up from Josh. Thanks, Josh. So I'm just going to start with an overview, and then I'm going to kick it off to Josh to, talk a little bit more about private equity education, the private equity landscape, and him and I are going to be going back and forth through different parts of this presentation. But just to orient you, when we look at private equity, you have had some exposure to private equity in the past. Certainly not a full-blown private equity portfolio, but you have the manager Landmark that you see in the MIP today. You funded them in 2014 with a $5 million commitment. At that time, we did have a positive view on secondaries. And so it was more of a tactical decision to kind of get some exposure to the secondary market, given some of the market environment that we were seeing at the time. You have about maybe 6 years remaining with that fund. They're currently in the process of distributing capital, and I say approximately 6 years remaining because managers can have the ability to do fund extensions, and that's in their terms. Additionally, you in 2005, so 17 years ago, you did fund John Hancock for a timber specific strategy. So it's private equity like, but more focused on what we'll call private real assets in the timber space. And that strategy is completely fully distributed and no longer in the portfolio. When we talk about asset allocation today, you'll see that we provided a sample portfolio with some ideas on how you could implement private equity from an asset allocation perspective. We did about a 10% allocation, funding private equity from public equity. So keeping your total equity at the same weight and just moving from public to private. 10%, we can talk about higher or lower with the group if you want to go down this path. Pick that. It does have a good risk return profile when you look at the overall portfolio at that 10% level. And it is similar to what the median endowment and foundation of your size invests at. If you were to go with the 10% allocation, we wanted to give you an idea of like what commitments could look like. And we have some information here about a pacing plan. So if you were to go down a private equity portfolio on an annual basis, NEPC would run a pacing plan for you, which would show you how much you need to commit to private equity strategies each year in order to, over time, get you to that 10% allocation. Private equity does take time to build up given the capital call and distribution nature of private equity. So we're thinking that about $15 million of commitments to start the program would be needed. Again, that's not 15 million going out the door funding a manager today. Those capital calls would take some time, and it would take about 7 years to build up to that 10% target based on our estimates. It could take a little bit longer if you went the fund-to-fund route, and Josh will get into some details on what's the difference between direct investing in private equity, taking about 7 years versus a fund-to-fund route, which could take more about 10 years. We're going to address 2 core questions in this presentation. One, should you have the program? At what allocation? What would that mean for the total portfolio if you were to implement a 10% allocation? And then how should you implement it? And again, that goes back to the question of what type of private equity managers should we look at? Should we fund? Directs, fund of funds, what are the different fees of those managers? As you think about this from a committee perspective, I think there's some questions as you hear Josh and I talk about. One, does this committee, want to dedicate time and potentially additional time to vet these managers? So Josh and I would bring you managers, we'd go through the managers, you would approve them like you do a normal manager. Sometimes these managers, and we've seen it over the past few years, these opportunities and manager funds come out and they're quick closing, meaning they say we're raising fund 3 and we're having a one and done close. We need your indication and we're closing by December 31st, get your paperwork in. So it could mean special meetings to review that. We're also going to talk a little bit today about the committee approving managers, but then there's also additional services that NEPC could provide. Today, as you've seen from me, I operate in an advisory capacity with all of you, where I make recommendations, but you all approve those recommendations. We do have an OCIO, Outsourced Chief Investment Officer service. It's called our discretionary service, where for some clients, NEPC does the due diligence and approves the managers through our discretionary committee for our clients. So there are other services that you can consider as you're looking at this as well. In terms of back office, the paperwork for these strategies are quite intensive, need legal review, legal input at times. So just keep that in mind. We're going to go through, our assessment of maybe how many strategies you may have to approve and do paperwork for on an annual basis, and can the back office handle that, as well as ongoing capital calls. So managers will come to you, on a quarterly basis, monthly basis, and say, I need, $1 million of the 5 million that you committed to me, please have it ready in the next 2 weeks and wired to me. So, that type of back office things are different than what you experience today. So again, can University of Maine system handle that? Or again, there is an additional service from NEPC where we would handle all the paperwork, all the legal review, and funding all those capital calls on your behalf if you gave us the authority to do so. And then complexity and illiquidity. As I mentioned in our performance review, you have enough liquidity in the managed investment pool, 93% liquid on a daily or monthly basis. So we think from our perspective that you could handle some illiquidity in the portfolio, especially at a reasonable 10% figure. But again, that's a question for the committee to ask themselves, if you have any information on future spending or things that could come up that you may want to consider as you're looking at this. So I will stop there before I turn it over to Josh and just see if there's any questions on the introduction and what we plan on walking through today.
Hey, Kelly, since this is a training, maybe I can ask some basic questions, but private equity historically is going to provide a stronger return than our standard format. Is that correct?
Then depends on the investment managers that are chosen. But yes, private equity can provide a return higher than public equities.
And in terms of fees, are they significantly more than our current format?
Yep. So Josh, I'm going to have you answer more the detailed private equity. I could answer it, but I'd rather have it come from you so you can give kind of the range of what the fees could look like.
Yeah, all really great questions. Some of which we do address later on in the presentation as well. So we did put some numbers around that, but it is more expensive than your typical public strategies. There's reasons for that. I mean, part of the reason is these are tend to be very complex strategies. Sourcing the best deals tends to be quite expensive. Talent at this end of the market is a bit more expensive. And so that all leads to being a little bit more expensive in the long run. But what we like to do and how we like to demonstrate performance to clients is on a net basis. So one of your questions was, does it tend to outperform the public portfolio or public equities? And that is certainly the goal, right? I mean, these are illiquid, they're illiquid assets, and therefore you should be getting a premium just based off of that. But when we show returns relative to the public markets, it's always in a net basis. So we're factoring out the fees and the carry. And then just that brings me to the next point. There are two sets of fees. So you have a management fee. On average, for a direct manager, a management fee is somewhere around 2%. And then there is what we refer to as carry. It's sometimes referred to in the real estate world as a promote. What it is it's a percentage that goes back to the manager, that if they produce a gain in the portfolio, they get a certain percentage, and then the rest goes to the LPs. That's typically about 20%. So 20% would go to the general partner, 80% would go back to the LPs. That, in our mind, that fee does two things. One, yes, it's generous and it does provide capital to the general partners, but at the same time, it does align incentives, right? That makes sure that the GP themselves are producing the highest gains, and they're incentivized to produce those high gains because that's where they're going to make the most money. And so those are the two sets of fees that we typically see within a private equity portfolio. Hopefully that answers your question.
It does. Thank you.
And Josh, could I just follow up? And then if we contracted with you to manage this, that's a fee on top of that, what would that look like?
So I'll take that. So in terms of your current contract with NEPC, if you were to go the fund-to-fund route, that is already included in our advisory contract. So we could come to you and recommend a private equity fund-to-fund for no additional charge. If you were to do some direct private equity managers, so not a fund-to-fund, that would be an additional charge that we can provide the figures to Tracy on. If you wanted to contract with NEPC to handle more of the operations or to select the investment strategies on your behalf, that would be an additional charge as well. And again, I can share those numbers with Tracy. Nothing like the fees that you pay to the private equity managers, though. These are incremental increases to the NEPC contract.
Kelly, can you or Josh comment on, I'll call it the penalty of being a public company? So you've got Sarbanes-Oxley compliance, you've got SEC, you've got a board of directors, you've got everything else. Can you put a sort of a percentage number on the fiscal penalty of being public as opposed to being private?
That is a really good question. One of which I don't think I could really answer in the form of like a hard number, but there is, as you can imagine, there's a regulatory cost. There is a certainly oversight by all the organizations that you just said as a company goes public. Private companies aren't faced with those types of regulations, which allows them to be a little bit more flexible. The one number I can point to you to kind of help you think about that is one of the biggest trends that we've seen over the last 5 years is companies staying private longer. And the reason for that is because of what you were just describing. There is a cost to going public. And one of the best things, the other things that I can point to you to also prove that point even further is a lot of the growth that a lot of these companies were experiencing in the public markets, they're experiencing in the private markets. And a good way to kind of test that thesis of mine is you have a lot of managers that have been historically mutual fund managers that have decided to open up private equity exposures. So think of kind of like the Fidelities of the world, the T. Rowe's, hedge funds like Coatue and Two Sigma. They've all raised private equity portfolios because they're not picking up that growth anymore that they had historically picked up in the public markets. David, I understand that I probably didn't answer that question fully, but hopefully it gave you some of an answer there.
Yes, you did. It was a vague expectation that you'd give me a percentage and say it was 3%, and that's why they tend to perform 3% better than public markets. But,
oh, you're asking how much does it outperform the public markets?
Well, no, and can we tie that back to the cost of being public? In other words, is there a defined cost? I mean, I know from a statistical basis, there's an outperformance, but I was just wondering if that could be tied back to cost in some way.
I see. I don't have that number. Sorry.
Can I just ask a question around implementation, Kelly, that you brought up? Whether it's a 7-year period with direct investments or 10-year period with fund of funds. In this space, as you alluded to, the capital calls can be very quick and need to be turned around in a very expeditious manner. So how would the portfolio itself be allocated to account for that? I could see if we're not in the public markets, then we could suffer a significant cash drag if we're reserving for 15 million to put into private equity in the initial tranche. That we could, I wouldn't want to have to sell equities into a down market to raise the cash for a capital call. So how does NEPC account for that asset allocation quandary?
Sure. So I would say generally, we would leave the funds in equity, like public equity, while we're building up the exposure to private equity. That being said, depending on the market environment that you're in at the time with the capital call, that doesn't necessarily mean that you have to pull from public equity to fund that capital call. If rates have gone down and bonds are up and you're overweight bonds, you can pull from there. Sure. Typically, we don't advise on leaving it all, the 10% allocation all in cash and for the time being to wait for your capital calls. As long as the funds are liquid and other types of investments, we would use that. So keep the public equity at above target while you're funding private equity. However, depending on the market environment, may have to pull from somewhere else.
Yeah. Do you ladder that out in any way, just in terms of, if you have the first year of known capital calls, that's going to be, $1 million or $2 million, have it, invested in maybe short-term treasury or something like that, just if you know that you have that liability coming, or is it just, pull it from wherever is most opportunistic in that moment?
In your case, because everything else is liquid, I would pull it from what's most opportunistic at the moment.
Okay.
It is probably important to note too that I'm going to use round numbers for a second here, and I know Kelly put together a pacing plan, but let's say you commit 10 million in year one, right? That full 10 million is not getting called in year one, right? That's
Right.
getting called over a period of time. So although you're contractually obligated to that 10 million, it's over several years that gets pulled. And then the other thing I would just add is, as the portfolio gets mature, right? You'll start to get distributions off of that portfolio. And sometimes those distributions, depending upon kind of where you're at in the period of time, those distributions can fund those capital calls.
That's a great point, Josh. Thanks. Any other questions from the group before we start to page into the materials?
Can I just ask Kelly, in other university accounts where we try to be conservative, is there sort of a norm about what others are doing around private equity?
So I have a page in here that shows, I'm just going to go to it since we're asking about it. Here on page 229, I put in your peers, and this is from the NACUBO study on kind of what their allocation looks like. And you can see private equity is about 12% here. They also do have, some more hedge funds than you typically do, but the 12% allocation there. They do also have, it looks low here, but private debt, which is fixed income and more of a private equity-like structure. I also have this page in here, and this is the investment metrics universe that your rankings are based on in terms of performance. So this encompasses, 100 portfolios, of endowments and foundations between 100 and 500 million. And you can see that the median allocation is about 10%, but that can range, 0, like yourselves, up to 30% in private equity. It also, I didn't highlight it, but real assets can be, commodities, but it can also be real estate. It can be more private real estate, private real assets. And even there's about a 5% median allocation there. So that could be part of that, some private equity-like investments as well. And you may pick up a little bit in the total fixed income if the endowments and foundations have some private debt. So it can range. And again, it depends on each individual organization's liquidity needs and risk posture.
Thank you.
And Trish, I would say the main community foundation has a 10 to 15% range, and I believe at the moment they're at 15% in private equity. And I would consider that a conservative portfolio.
What we've been seeing with our clients that do have private equity is if, their target's 10%, we're seeing them be much higher just because of what we've seen with public markets, declining, fixed income declining. You have that denominator effect where your private equity naturally goes up above targets. Okay. Josh, why don't I turn it to you to talk about some of the benefits and considerations and kind of the market landscape for private equity as well.
Yeah, sure. And then look, this is for you all. So if there's points that you want me to stop, spend a little bit more time on, please do. Or if you want me to move on, I'm also, that's okay too. I want to spend as much time on the important stuff that's important to you all. So some things that we consider as benefits to be able to have a private equity portfolio. And one of the bigger benefits is so you get the ability to have these assets, right? And we were talking a little bit that private equity tends to outperform public markets, but even within private equity, you have a lot of control over the risk return profile. There's a lot of options. We break it up into, really broadly speaking, 3 buckets. So you have early stage, that's your venture kind of startup type environment. You have growth, that's really when they're turning on the top line, revenue growth, stuff like marketing, sales teams. And then you have the buyout managers. These companies tend to be a little bit more mature and tend to take majority ownership of these companies. They come in, they make the company much more efficient, package it up for the next natural buyer. So there's a lot of flexibility within kind of that risk return profile within private equity itself. We do view it as a potential return enhancer to a portfolio. I think this is probably one of the more important bullets, even though it doesn't have the most words. And there and a couple of things that just doesn't jump off the page. One, it is tactical by nature, right? And so if you just think about the asset class and kind of what this bullet's trying to tell you, that means one really important concept. It's a market that you can't really time. We're going to get into a little bit about that later because Kelly had me asked me to make some comments of whether or not it's a good time to be investing in private equity, but I'll save some of those comments for later. But just understand it is one of those asset classes that you want to have a consistent pacing plan. You want to adhere to that pacing plan. It is, again, tactical by nature, and then you let the managers that you're hiring be tactical with those dollars within certain segments of the market that are showing more favorable economic reasons to be investing. And then lastly, it is a broad universe for impact or mission-driven strategies. There's a couple reasons for this. One, that is something that is becoming more and more prevalent and wanted by investors today, which by nature means that it tends to lean a little bit more earlier stage. And so we see a lot of impact investing in the venture space. Technology is what's going to solve a lot of the issues that we're faced today. And so naturally that technology needs to be founded, built, supported, and the private markets are doing that. The other thing is it's not a world like you see in the public equity space and where they're applying some sort of negative screen or screening to portfolio companies. These GPs have full discretion on what's going in the portfolio, and they're building portfolios of about 20-ish investments. And so it's concentrated. So an impact investor will certainly spend a lot more time making sure that those very best impact investments are getting into those portfolios. Some of the considerations, we talked through that a little bit, but it is an illiquid investment class. Think of kind of 10-year hold periods. Contractually, most of the LPAs or limited partnership agreements, you're signing up for about 10 years. Those typically go beyond the 10 years. There are extensions. Kelly was talking about that a little bit with some of the stuff that's in your portfolio today. We're seeing, fund life somewhere between 12, 15 years. Some of the earlier stage stuff, especially if it's a fund of fund, I mean, those can get extended up to those 18 years. So they tend to be really long. We like to view it as, we always say it's like a marriage in investing, right? Long term. And we take that very seriously. We spend a lot of time diligencing these managers, understanding these managers, because we do understand that we're setting our clients up for these long-term assets. The benchmarking on it, look, I would say it's getting better. It's not a perfect world. We tend to, there's a couple ways that you view performance on a private equity portfolio. So it's an IRR. So that is a time-weighted based performance measure. We also do it on a multiple base. So that's taking your invested capital, how much have you received and how much value do you have in that portfolio relative to how much you invested. That gives you a multiple. And then there's what we refer to as a PME or public market equivalent. And that's basically saying is if you took $1, invested $1 today in a private equity portfolio and also invested that same dollar into the public market equivalent, sometimes we use the Russell 2. I have a slide on that later on, and or the S&P. And then same if you received a distribution back at the same time, how did the public market equivalent react with that distribution at the same time? It gives you a relative basis of, okay, how have you outperformed the public markets? Okay. And then look, it is, if we do decide to go international with your portfolio, you are subject to those international currency fluctuations. Hedging these types of stuff is very expensive, so it tends not to be hedged at all. And so we do take that into consideration. I will say that the bar is super high when we think about kind of going outside of the US. at the very least, we would like to think that the manager can outperform any US manager just based on the currency risk, and then obviously the geographical considerations that we have to take into account. I'll pause there. Any questions? Otherwise, we'll move to the next slide here. Okay, so I would just focus a lot of your attention mainly on the first bullet, and this is describing how managers can provide returns to you all, and what makes this such a great asset class to be a return enhancer. Okay, there is the simple concept that most investors try to adhere to, though I will say many of them probably get it wrong because we invest with our emotions. Many of us invest with our emotions rather than investment standards. But when you think about kind of buy low, sell high, right? So the ability to buy something cheap and then sell it later on for something more expensive. Okay, that's what we refer to as the multiple arbitrage. There is the growing of EBITDA. So that's making a company much more profitable. What levers can you pull there? So taking out costs, driving up revenues, anything that can create that profitability to go up. And then you can use a lot of buyout managers will financial engineer returns. And so they'll take debt out and then do a dividend distribution, things like that. I will tell you that the first bullet and the last bullet are things that we tend not to focus our time on when we think about managers. We really try to focus on kind of what is their secret sauce? How are they actually making these companies more profitable? That takes a particular skill set. That's what you're paying the 2% management fee for. And so we like to find those managers that can do that. And so we spend a lot of our diligence time focused on kind of, okay, what levers are you pulling at the company level that are enhancing these returns? Are you taking board seats? Are you bringing in, do you have the ability to bring in really strong management teams? Can you make the financials much stronger? A lot of times, a lot of these companies, especially in the buyout space, what makes them inefficient is they've never had a CFO or anything like that. So having someone that's professional that has done this quite a few times to come in and kind of get the books in shape to understand, kind of just understand the company itself, it could be a huge return enhancer. And it's all about packaging up the company for the next buyer. So whether that be the public markets or a strategic buyer to take it out. And then I think the last thing I'll just touch on this slide is there's two ways of creating returns to you all, right? It's the sell of the company. So that's the capital appreciation part of it. Or it's the income piece, right? The dividend distributions. Because some of the more late stage managers do use leverage to create returns and distributions, there is an income component that can also come along with this. Okay, so the next slide is, this is a really busy slide. I get that. And so I think what I'll do is just focus your eyes on one line graph here, and we'll spend our time with that. And that is the blue line graph that's on the top there. Yeah, Kelly's pointing that out now. And what that's going to show you is post the Great Recession, private equity has been a really great place to be investing. So this is taking that public market equivalent that I was describing to you and showing what that illiquidity premium is over the median return for private equity. And so as long as that's positive, that means that you're picking up a return higher than whatever that public market was demonstrating. That blue line is using the Russell 2. We think that's probably more appropriate when you think of just private equity strategies themselves. Those companies, there's no perfect index in the public market to really use, but we think it's a little bit closer than the S&P. Those S&P companies tend to be a lot bigger than the private equity companies. So it's a little bit of a harder way of describing returns. So we do like that, but we did add the S&P for those that are interested. But all that's showing you is it's been a really good returning asset class. One of the questions that Kelly asked me is now a good time to be investing in private equity? I'm sure that's all in your minds too, because as you can see, it's had a really good run. And you know, one of the things I will tell you again, I'm going to reiterate, timing markets is really, really tough. Again, you're signing up for a 10-year term. Typically, these funds are investing over 3 to 5 years. I will tell you, I always like to go back to 2020 when I tell clients and say, hey, listen, in 2020, So in 2017, would you ever predicted that there was going to be a pandemic, right? There's a lot that can happen in 3 years that can sway markets back and forth. And so we really tell clients, don't time the markets, really get that vintage year diversification, because each vintage year that you, by the way, I'm sorry, let me take a step back and just describe a vintage year. We describe everything in vintage years. It's basically a vintage year is the year in which you make an investment, and that is what you use as a peer set to judge performance against over time. And what we tell clients is you really want to have vintage year diversification. Kelly has set up a pacing plan for you. Stick to that pacing plan, and over time, what you'll be subject to is multiple economic and business cycles. And then what you hope for is that portfolio, because they're benefiting from those economic and business cycles, that they're able to generate returns that are superior to that of the public markets and their peers. Okay. The last thing I'll just point out here is on the timing aspect. So if you go back to 2008, you'll see that anything post the Great Recession has been really good. And so what studies show is that post recessionary periods, private equity tends to perform better. It's a really simple concept, and that it goes back to that buy low, sell high concept. And that is, as private equity returns will look good, that tends to drive up valuations. And the higher you pay for a company, the less you can get on that multiple expansion. And so that buy low, sell high concept gets a little bit tighter, and then you run into that issue. We've seen valuations get extremely high over the last couple of years, and even higher over post-COVID. And so, now that we've seen a sell-off in the markets, a little bit of a cooling in our economic cycle here in the US and more broadly globally, we're seeing valuations start to come down. They haven't moved in such a way that has got us really excited on a value play, but at the end of the day, we're starting to see that cool. It does take some time for those valuations to move from the public markets to the private markets. There is a bit of a lag. Somewhere around 6 to 8 months is typical. And then what we're predicting is, if we continue to go through this cycle right now where we're seeing down public markets, we'll start to see valuations flow through in September to the end of the year. And then managers will have potentially an opportunity to be deploying capital in what could be a very interesting time with lower valuations. I'll hit pause here because I recognize there's a lot on this chart and we had some questions around it. So just if there's anything that you want me to dive in on, happy to.
Hi, Josh. I guess one question I have, in general, I think it makes sense to have private equity in the portfolio. I guess my question is, to what degree, in your opinion, is it important to have access to top tier managers? Would the system have access to those top tier managers on your platform? And then could you also just kind of provide some color around the team you have and the due diligence process that you go through when you're trying to select managers and investment opportunities, given that there is a very wide range of opportunities within this space, and the variation from year to year with various vintage years can also be a lot of differences?
Yeah. So first off, Matt, thank you for that question. It is a very important question. So what I will tell you is manager selection is probably the most important thing when it comes to a private equity portfolio. Many reasons for that, but what we like to say is the very best managers can perform on a relative basis, but can perform relatively well irregardless of the economic cycle that they're in. So yes, what we try to spend all our time on is the very best. We are a best idea format company, and what that should tell you is we do boil the ocean. We try to meet with almost everybody in the space that's relevant, and then from that list, boil it down to who the very best players are. that leads to Matt's next question is, okay, so how do you get that access? Can you describe the team a little bit? It is a very inefficient market at the end of the day, meaning that it comes down to relationship building and networks to be able to access these managers. The very best managers, just to be quite candid, don't need capital, right? They have their LP base. Very often they're not looking for new capital. And so what we've done here at NAPC is hired a team with experience and those that have sat in your shoes and or a form of your shoes and set and built those relationships over time. So I gave you my background. I had 10 years at Liberty Mutual investing off their balance sheet. That portfolio dates back to the 80s. A lot of great relationships that they've been able to build. A great network that I had that I've been able to build over time. I hired someone by the name of Nick Mann. He had experience at a family office. He has very similar experience to mine in the sense that he's been in the space for about 10 years, and he's focused exclusively on buyouts, and he's built a lot of strong relationships there. We have a team of very talented junior professionals that we're spending a lot of time with mentoring, because at the end of the day, I will tell you that I have both an undergrad in finance and an MBA. This asset class isn't something that you learn out of a book. It's something that you have to learn on the job. So the seniors team has taken on the responsibility of mentoring and apprenticeship and making sure that the next generation here at NAPC is ready and building those networks. And so we spend a lot of time making sure that happens. We have an 8-person team that's focused on it. What we say is each diligence on average and this is an estimated number as well, but on average takes about 50 hours. And we spend those 50 hours meeting with the manager several times, walking through their portfolio, really understanding kind of what we say is that second layer of thinking, right? Anyone can take a manager's returns, compare it to the peer set and say, yes, you've outperformed your peers or you haven't, and use that rear view mirror look and say, okay, yeah, this is a superior manager. However, what we will do is we definitely look at that, but we go layers deep, maybe 2 layers deep. Understand the team. What are they doing? What are the alignment? What's the alignment like with the team? How are the economics within the team aligned? Do you have someone there that's creating those outsized returns? If so, how are you compensating them? How are you keeping them? All really kind of important questions. So we have models that are set up to help us with that. So tools, but we also have the networks to be able to verify that. So, reference checking, things like that. Matt, hopefully that gives you a flavor of what we're doing, but certainly can dive in any direction if you wanted to.
Okay, great. Thank you.
You're welcome.
So, Josh, just one final question for now. And if we get into the, say we understand it, we start kind of building a plan here, there is a thought process though that says you do need some kind of chief investment officer to manage this private equity component of a portfolio in-house or outsourced through Kelly and the team. Is that correct? Kelly Regan and her team. This would add an additional layer of complexity to our administrative function. Is that what I'm understanding?
It would. There's certainly Kelly, if you could go to there was a slide in here. I don't remember the number of kind of where we built the portfolio. It talks about some of the transactions that it would produce.
Yeah, right here.
Right there. So it does add a layer of complexity. It is something that certainly we'd be willing to help you all with. It depends on what direction you go to, right? So we've outlined two things that you can do here. You can go the fund of funds route. That tends to be a little bit more administratively less complex, meaning that you're outsourcing a manager to go out and select other managers and put it into a portfolio. You will need someone that will satisfy those capital calls, distributions, understanding the NAV, reading through quarterly reports, stuff like that. We talk to each of our FPL managers at least once a year on a formal basis and create a update note based off of that. I will tell you that we are talking with our FPL managers far more than that. We spend a lot of time with our FPL managers. I would venture to say probably on average, we're touching base with them, once a quarter. Really kind of, we use them as good resources to understand kind of what's happening in the market itself. And then certainly if you go the direct route, that gets a little bit more complex. That's basically building a portfolio of what the fund of fund manager would be doing, but you're bringing that in-house. And those, you would have to have someone that would be managing that closely, right? I mean, that is something that you would want to pay attention to, think through. We do help our clients think through that. Building the portfolio is one thing. It gets to a point where, obviously, and then maintaining that portfolio over time, right? Do you decide whether or not you want to replace a manager? Why would you want to replace that manager? Is there someone better that we could put in that portfolio? So it's always a moving target from that perspective. That last line there, I went and estimated, and this is an estimation, so please take it that way, of the types of transactions you would expect in a year. So there's a lot there, right? So if you go to the directory, it's somewhere around 100 plus transactions. That's capital calls and distributions, valuations, things like that. On the fund of funds route, somewhere around 50 is what we would estimate.
Thank you.
You're welcome. And just Steve, Sven, to add a little bit more to that complexity, these are long dated assets too, right? I mean, these, again, 10-year plus strategies.
Josh, could you go back to the timing issues? I noticed the chart earlier went to 2018 only. There's a threat of a recession.
Yeah.
So when would we make this conversion? Would we wait this out until there might be a recession? It's a better deal?
Yeah. So the reason why we go out to 2018, Tricia, there's a couple things I'll answer there because I think there's a couple questions there. The reason why we go to 2018 is because we view post 2018, so 2019, 2020, and 2021, those vintages are just getting off the ground. They're less meaningful. And so there's a lot of noise, one good or bad within those portfolios. And so we tend to exclude them when we think about just performance. As far as weighting, one of the things that I will say is if you think a recession is looming, which I think there's probably some data points that we can certainly point to and say that potentially is going to happen. Most recessions are kind of viewed in the rearview mirror too. It's like, oh, the recession happened a couple of months ago, versus like being able to actually predict the recession. The other thing that with a private equity portfolio, and I alluded to it earlier, was that you're making a commitment today that's being deployed over 3 to 5 years, right? And so to wait would almost suggest that you could miss, quote, a good economic time too. So I would say now feels like a pretty good time to have dry powder to be able to give to managers to put to work for you over the next 3 years. I would say if you're going to do it, now would feel like a pretty good time to do it.
But now would mean, because I look at that chart and I look at those, the recession chart and the 18 chart, now would mean when would we actually be purchasing it? When would it actually be implemented if we began to look at managers now?
Not understanding too much around, and I'll let Kelly answer some of this, not understanding too much around kind of what the process may look like for you all. Let's just say in theory, if we decide today that we're going to turn on a private equity portfolio, right? We'd go out, I'd give Kelly our FPL list. Kelly would take the FPL list, present those to you all, assuming that you could get something done with, let's say, within the month. That would give the manager, they would end up having, you would close on it, they would have the dry powder starting in November to be able to deploy it as they see fit, right? Some managers may wait on the timing and say, now we haven't seen the valuations adjust the way we want them to, we're going to sit on it a little bit. some will start to deploy capital. On the early stage side of things, what we're seeing is some of those managers starting to deploy some of that capital. So I would say, it depending on how quickly you can move, it could be as early as this year you can pick up some vintage year exposure. My guess is we're probably talking about likely next year. And so if we're thinking about next year, I think next year actually we'll start seeing a lot more adjustments in valuations. I will tell you this, in private equity right now, we're starting to see 630 valuations. 630 valuations haven't moved a whole lot. We've seen a lot of movement post 630 in the public markets. We are also noticing that private equity portfolio companies are burning cash. They're going to have to go out and raise capital at some point, and they're going to do it either at a flat or down round. I'm thinking more likely at the down rounds, and therefore that would provide the good opportunity. We just haven't seen that influx of companies going up for sale or raising capital yet. And so, I feel like next year could be a pretty decent time to be able to deploy capital.
Okay. I just don't want to buy high.
Yeah, that's it. Well, and Trish, I'm going to make it funny here. If you're asking me to predict a recession, if this is the way of me trying to predict a recession, I'm absolutely not going to do that.
Wise man.
These are all good questions. We have about 8 minutes left in our session. What should we focus on for the remaining time that would be most helpful to you? We have the asset allocation chart, going around that 10% allocation. We have a little bit more information on the differences between fund of funds and direct investments. And then just some, closing comments. So what would be most helpful for you all?
We should probably see if Tracy's having a nervous breakdown.
I'm not, but thank you. Very helpful information. I would just say a couple of things. We are actually working right now with procurement on looking at engaging a consultant to assist with an RFP for advisory services, as we've mentioned in the past. So timing would, certainly want to think about that, because I wouldn't imagine we'd want to start a private equity process if we're not certain as to an outcome with an RFP on investment advisory services. And then, of course, the other consideration that we've talked about before is that the University of Maine system has a deadline for issuing its financial statements to the state of November 1. And in recognizing those processes to work around the challenges of private equity and the valuations and wrapping up the audit for that. But that's something that would impact us internally and needing to navigate with the auditors.
And what's the status of that RFP, Tracy?
We are actually just working right now on drafting the request for information to engage a consultant, given the breadth of the scope of the work, which would include advisory services for what you heard today for the defined contribution plan, as well as the 3 that NEPC currently advises on, and some additional scope that we've considered and wanting to understand what entities might be able to service there.
Thanks for that, Tracy. So again, just want to be most helpful to you all in this educational session. I'm not sure if the implementation options would be helpful. I think some of this might be helpful as you think about that RFP too, kind of, the services that consultants can provide you with the private equity. So maybe it'd be helpful to go through this, but happy to take this in whatever direction for the last few minutes.
And that certainly would be beneficial to me, but I defer, of course, to the committee.
Okay. Josh, you want to spend a few moments on a little bit more about the fund of funds versus the direct, the types of strategies we have here, and then maybe even the fees too.
Sure.
Yeah.
Yeah, absolutely. So why don't we just focus our time on, so we talked a little bit about fund of funds, we've talked about direct funds. I hopefully explain those in a way that you all understand the differences between the two. I think when we think about building a portfolio, I like to encourage clients to think about doing a blend of the two up front. So being able to use a fund of fund manager and a second, we didn't talk about secondary managers. I'll talk about that in a second, but be able to use those two strategies up front. And then layer in direct investments over time and start to walk back those strategies. And I think there's real good reasons for that. One, on the fund of fund side, you're going to pick up diversification pretty quickly across assets, sectors, geography, things like that. On the secondary side, we really view secondaries as a portfolio tool, and it's really good at mitigating J curves. Okay, so just to spend 1 second on a J curve, think of a new portfolio that's held at cost. It's still calling that 2% management fee. And that causes a drag on performance. That causes your IRR to dip negative, right? It's not a concern because the portfolio still had it held at cost, but because they're still drawing management fees, your NAV dips below invested capital, and therefore you have a negative returning fund. The hopes is over time, the portfolio starts to get written up. You have a lot of great portfolio companies in there, and then that performance tends to pull that right out of the J curve. One of the tools that we can use is a secondary manager. And what those managers do is they go out, they buy typically a pool of assets at a discount. And then when they pull that discounted pool of assets into their portfolio, accounting rules allow them to write that right up to market value. So because they bought it at a discount and they pull it into their portfolio at a higher market value, you have an instant write up in the portfolio. And then that tends to, on an aggregate basis, pulls your portfolio out of the J curve or at least mitigates the J curve a bit. And then over time, we would walk back that secondary strategy, those commitments that you would be making on a 2 to 3 year basis, walk those commitments back. So reducing the capital being deployed into those and go more into a direct fund. Because one of the things that a fund of fund manager, maybe Kelly, we can go to the fees real quick. One of the things that a fund of fund manager has is an extra layer of fees. Okay, so they're investing in those pool of managers, those funds that have fees themselves. Then the fund of fund manager charges a fee to source and manage those managers. And so we've outlined it, and this is a big estimate at the end of the day, but just doing some quick back of the envelope math on the portfolio that Kelly had put together, we're saying a fund of fund manager would charge somewhere $5 million on top of the pool of assets they would put together underneath. And so there's another layer of fee there. You could use maybe that 10 million on the direct side as a good gauge of kind of what that underlying fee may look like. But it'd be far more efficient to kind of go into the direct fund approach, because the direct fund approach, you don't have that extra layer, if you will, of fees sitting on top of it. So we try to, for portfolio and administrations that can handle it, we try to get them to go more on the direct fund of fund approach because it's a lot more efficient use of capital. But we recognize that with a new portfolio that happens over time. Just for modeling purposes, this is the management fee, not the carry aspect of it. So it's just straight management fee. I assumed on the fund of fund side, a 0.75% management fee. On the direct fund side, a 2% management fee on committed capital through the first 6 years of a fund, with a step down of 1.5% in the latter years of the fund, about industry averages for both. And then Kelly, if you just want to go up, because you wanted me to hit on timing real quick, I'll just hit on the timing aspect of it. So really focus your eyes on the direct. We've talked mainly about direct investments and the fund of fund side of things. I think the real thing to point out is, these are long assets. The green part is your investment period. That it takes time to deploy these investments. I will tell you, on average today, we're seeing somewhere around a 3-year deployment. That could get extended out a little bit now, just given where the markets are and just deployment paces are down. Then you have this harvest period. So that's when they go out, start selling a lot of the companies that have done well, and they've kind of implemented their plans to get them ready for the next buyer. And then they go into the liquidating phase. That's really kind of when the portfolio's liquidating the rest of the assets that are in the portfolio. Some of this could be some of their big winners that they've been holding on to for some time, maybe taking a little bit more time to get to maturity, and or kind of getting rid of some of the assets or writing down or winding off some of the assets that haven't done very well. On the fund of funds side, you have that investment period. You have an extra layer of investment period because you have the fund of fund manager investing into underlying managers, and those underlying managers take some time to invest. And then you have the harvesting period and liquidation period. Everything ends up becoming a little bit more tail end loaded relative to the direct investment way.
If I could throw out a really dumb question, Josh, which I always tend to be able to do, the interval funds and that type of thing. I know we're not talking about that as a way of getting exposure. Is that something that never would with an organization our size be looking at, just because I don't know, it being 1940 Act fund kind of stuff? Or
yeah, I think I'd answer it this way. I think you have a sizable enough portfolio and the ability to do this in a way that could enhance returns to the upside, that I think it's probably better that you go the traditional private equity route.
Right.
And by the way, I love all questions.
Well, I'll ask one if I may. And thank you, Josh. That's very helpful. I'm also thinking about, in the managed investment pool, we have third-party investors, and I'm curious on the ability to mark to market. And if investors come in early on, maybe they'll suffer losses, and if they should exit our pool, maybe they'll maintain those losses. And if they come in later, will they, enjoy profits from that? Or I'm just curious if the marking to market is a very difficult process and how much it really reflects the return to that point in time.
Yeah, a very fair question, complex one, I will say at best. But what I can tell you is that on a quarterly basis, you get a valuation of the portfolios. And then at year end, so defined by calendar year end by most managers, if not all, but I'm going to hedge it by saying most, is a calendar year end of 12/31, and that's when the audited financials come out. What I think most people do in the space, although Kelly, certainly, if I'm coming off the rails a little bit here, please stop me. But what I've talked to with other types of institutions that have a very similar kind of need, Tracy, is that you come up with a very strict valuation policy and you stick to that valuation policy of your portfolio. And whatever that is how you would deal with people coming in and out at certain periods of time. I will tell you that that's how regulators like to see it, is that you kind of come up with this strict policy and that you adhere to the policy. They care about the policy maybe more so than kind of how you're valuing the portfolio. And then typically how you would rely on the valuation of the portfolio, right, is you'd certainly get the marks from the manager, and then you'd have maybe an understanding of kind of where the public exposure may be within your private equity portfolio, because you'll have some public exposure in there. And then you may be able to kind of adjust the valuations based off of that. But at least on a quarterly basis, you could more or less strike a market value.
Yeah, thank you. That's helpful. And we do have a strict policy, so I appreciate that comment. Thank you.
Okay. Yep.
One other thing that I just want to point out, and we put in the materials for you, we don't spend too much time, but we showed you slides of kind of like what we talked a lot about pacing plans. And this kind of shows, if you were to commit to that 10% target and you did the direct portfolio, kind of how much in each, calendar year, this is as of June. So I guess your fiscal year, what you can expect to commit in totality. So about 14 million to start, and then it kind of ratchets it down a little bit to 8 million. And you can see kind of how this gray line is your, projection of what the value of the portfolio would be in terms of total percentage of the portfolio versus the red line target. So it's kind of like where we came up with, it's going to take about 7 years or so to get to that 10% allocation. And then we did one for fund of funds. If we invested there, again, investing a little bit more each year, and still taking about a full 10 years to kind of get up to that target. So just want to show you that there's some additional slides in here, and kind of that's what the goal of them was for, just to show you how much in each year you would commit. And again, that's not to just one manager. You'd want to diversify it across multiple managers. And then how long it will take you to get up to that target.
And at that point, Kelly, would that asset allocation be pretty much self-funding with, essentially any sorts of redemptions or returns of principal funding any new capital commitments for new funds? Or would we have to be continuing to add cash from other sources of the portfolio to keep this going?
Sure. So you'll have to, this is just the first 10 years. If you're going to keep that portfolio going at the 10% allocation, you'll still have to commit, 11 millions or so in what, 2033 and the next 10 years out, right? So you'll still have to keep committing in each year. This is just showing you the first 10 years. But then Josh mentioned it later on that, those capital calls like that you're getting out in years 8, 9, and 10, by that time, you'll be getting distributions back from some of the earlier funds that you've committed to. And so that should be self-funding, where those capital calls should be funded by most of the distributions from these funds that you invested with in the early years. Any other questions for Josh and myself? I want to be respectful of all of your time. Okay, hopefully this was helpful to you all as you kind of go through this and think about adding the allocation and go through the RFP process as well.
Thank you, Kelly and Josh, for that comprehensive educational session. Much appreciated. It's definitely something that we need to give consideration to in our asset allocation. So thank you. Anybody else have any final comments, questions, concerns? I'm going to give you back 6 minutes of your day.
Wow, thanks, Kelly.
Yeah,
Even after a break.
so generous today, aren't I? So I guess with not hearing any additional comments, I'll conclude the meeting.
Maybe there is one, Kelly. What is the timing for a decision about whether to move to private equity?
Is that addressed to me?
Yeah.
I guess I guess to answer that question, when we feel that we're ready for it.
Okay.
After absorbing this education and looking at our options.
Okay.
And being mindful that we're in a process, an RFP process right now. So
thanks.
I know it's not an answer, but
that's okay.
Definitely it's
the RFP matters. I guess
something that we definitely have to give a lot of consideration to in the allocation and so it's definitely right in front of us.
Yep. Thanks.
Any other? Okay, well, I guess I'm only giving you back 5 minutes now. So go and have a beautiful day, beautiful weekend, and I'll see most of you at